Hey, babe, check. Start of cash equity trading on Francine Lacroix in London with Tom McKenzie.
And here are your top stories. Powell crushes bonds. The Fed chair says he's ready for 50 basis point hikes if necessary. Goldman sees the FOMC raising by half a point in May and June. Short-end rates lead a global surge in yields, posting one of the biggest daily increases of the past decade. The gap between 5- and 30-year treasuries narrows to the least since 2007. Plus, higher and higher oil jumps again as the EU debates a ban on Russian crude. Moscow refocuses its attacks on the besieged city of Mariupol.
Tom, let's also take a look at the futures. It was interesting yesterday, or certainly overnight in Asia, to see a lot of the concerns from the more dovish tone from Jay Powell, the fact that actually it points to a slightly more difficult outlook to deal with, being shrugged off in Asia. It seems for the moment that we're doing the same with the DAX futures, pretty much flat. The FTSE down some, gaining actually 0.2%, but let's see how they open. And it's so nice to have you back, my partner in markets.
It's good to be back, Francine. A bit of a modest turn in the futures, and now we have the open, of course. The FTSE 100 gaining 0.2%. It was the focus, of course, on those comments from Jay Powell. It seems to be the takeaway is that the key risk, as far as Jay Powell and the FOMC sees it, is that inflation is more of a risk than the concerns about the impact on growth when it comes to the conflict, the war in Ukraine. So opening the door, Jay Powell, for that 50 basis point hike in May. Goldman Sachs, as we say in the headlines, looking at 2. Across the Treasury curve, you're looking at yields at the highest levels since about 2019. We'll look at those, particularly the 2-year, in just the next few moments or so. The yields have come off a little bit, but as we're saying in the headlines, a pronounced move in the last 24 hours or so. The FTSE 100 gaining 0.4%. The Spanish IBEX also up. Similar territory, 0.5% of the gains. Over in Italy, you're seeing gains of about 110 points. The German DAX is gaining 0.2%, and the CAC 40 over in France is up just 0.1%. Let's look cross-asset then as we focus in on the future stateside, and the gains, just very modest gains when it comes to those futures, given what we saw on the back of the commentary from Jay Powell. So the cross-asset board now, and then the 2-year yield as well, because that's where the focus has been in terms of that hike, in terms of that move higher in the yields. You've seen it across the 2s, the 5s, and the 10s, but it has been more pronounced on the 2s. At one point at 217, the last time I checked at around 215. Here you go, the futures stateside pointed to gains of just 0.1%, 215 on the 2-year, coming off a little bit from the earlier highs in terms of the yields, but still up 4 basis points in today's session. The Bloomberg Dollar Index is supported up 0.3%, and Brent crude, we continue to watch those discussions in Europe. There are divisions clearly now along those lines around whether or not you should cut your dependency on Russian oil. That debate continues in Europe, gaining 1.4%. Francine.
Yeah, so Tom, these are the sectors that are moving. Now, if you look at the overall index, it's getting some 0.2%, so nothing huge. Actually, if they're trying to stabilize healthcare, travel and leisure on the downside, but again, they're pretty much flat. They're only down some 0.1%. On the upside, we have banks, energy, utilities, basic resources, and technology. But again, they're only gaining some 0.9%. So for the moment, Tom, it does seem that they're pretty, I don't know if it's range bound, but certainly the moves are not huge on either side, either on the downside or on the upside. And then you can see it's still energy, materials, and some of the other staples that are actually supporting the session today.
Let's get over to Bloomberg MLive Managing Editor Mark Cudmore. Mark, good morning. You're looking at the yield curve, obviously, given what we heard from Jay Powell. Where is your focus?
Yeah, good morning, Tom, and welcome back to you. I'm just back from holiday myself, so rather than doing fresh analysis, I actually revised some stuff from 3 years ago. It's perfectly appropriate again today. I grew up kind of getting trained in markets in the early 2000s that the rates markets were the ultimate leading indicator for markets. And that was definitely the established wisdom and was the case. The great financial crisis and the relevant or related monetary policy kind of ripped up that kind of rule book, and rates have been less relevant in the last 13 years. Therefore, we've forgotten how to read signals. Now, there's been a lot of rubbish spoken about the yield curve over the last few weeks and a lot of kind of panic mongering about what signals we get. First of all, it's important to say that there are many different segments of the yield curve to look at. Now, Jerome Powell overnight brought attention to the front end. So I'm having a look here at the 3-month versus 10-year part of the curve. And this is over the last 35 years. That's the white line, the spread between 10-year yields and 3-month. Now, it's actually steepened out to the widest in more than 5 years. So when you hear about yield curve flattening, sure, some parts of the curve are flattening, but the 3-month, 10-year is actually steepening quite aggressively. And many curve purists would say this is actually probably the most important one. Now, the blue boxes in this chart are recessions in the US over the past 35 years. And you can see absolutely perfectly, every single one of those 4 recessions was preceded by an inversion of the yield curve, normally with a lead time of about 7 to 13 months. So we have all 4 of them. It's worked perfectly. There's not even been a false signal, unless you maybe count this one. Maybe it's a long lead time, but there's not really been a false signal. It's been absolutely brilliant. At the moment, this is steepening. So you look for a recession normally after it inverts and then re-steepens, but we've already had the recession for that steepening. So this curve spread in isolation would imply we're actually quite early cycle.
So it's contradicting Jay Powell.
It's not exactly, he's kind of saying the same thing. He's saying you've got a lot of room to kind of hike in the coming months. He was bringing attention to the front end, and he was talking more about like 3 months to 18 months, but he's saying there's still room to hike. He was actually saying, no, we're not going to get a recession anytime soon. So this is actually saying the same thing as Powell. It's a different part of the curve. It's also saying that there's no recession anytime soon. Yeah. Now, I would warn both about relying on what Jerome Powell said and what I'm saying, even though we're agreeing. Don't rely on one part of the curve in isolation, because different parts of the curve can say different things. And I think in this case, you do need to look at many different factors because we're in a regime shift in rates.
Yeah, Mark, thanks so much. I mean, I think to oversimplify, an inversion of the yield curve typically means that actually it's a negative sign for the economy. But Jay Powell keeps on saying, look, the economy will flourish. So let's see where that ends up.
And the complexities of the moment that we're in now as well, and just pointing to that and highlighting that in his speech yesterday, Francine.
So as we were saying, Fed Chair Jay Powell said yesterday that the central bank will take the necessary steps to get inflation down, even if that means increasing rates more rapidly than currently anticipated.
We will take the necessary steps to ensure a return to price stability. In particular, if we conclude that it is appropriate to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings, we will do so. And if we determine that we need to tighten beyond common measures of neutral and into a more restrictive stance, we'll do that as well.
Let's get into the key market drivers now with our markets editor, Christina Keener, and Sebastian Radler, Bank of America, head of European equity strategy. So thank you both for joining us. I feel like everything's changed in terms of the messaging, Christine, that we had from Jay Powell. He's talking about 50 basis points, and actually just the tone in which he's doing it has changed from what we heard him say a couple of days ago.
Absolutely, Francine. And I think this really puts back the notion of a 50 basis point rate hike on the table. Remember that before the war in Ukraine broke out, this was definitely the key theme for discussion among market participants. And this was causing a lot of hand-wringing among investors. And of course, that kind of took to the sidelines as investors started digesting the implications of the Ukraine war. But I think what Powell has really done yesterday with his remarks is really put that back on the table. And, you know, we're starting to see markets kind of coming back to that sort of idea and reawakening to the possibility of, once again, a supersized rate hike from the Fed, potentially as soon as May.
Potentially a supersized rate hike from the Fed. Let's bring you in at this point, Sebastian. Thank you for joining us in the studio this morning. How would markets react to that? Have they started to price this in? Where are we in the repricing of a more hawkish Fed?
So first of all, the most important way that feeds into equity markets is via higher real rates. So the question is, how high can real rates go? But that's not just a function of how much do they hike now, but also how far and for how long will they be able to go. And I think what we're seeing in the background is we see slowing growth. Growth will very likely be back to trend at the end of the year, below trend by the middle of next year. And therefore the market, if you look at the pricing, saying they will not get very far. They will hike this year, maybe early next year, but then growth slows and you're getting into the end of the cycle, and that puts the curtain down.
what does the inverted yield curve, Sebastian, actually mean for where we end up in the economy? And again, I mean, the nuance that Mark Cudmore was bringing is that actually, what he's looking at, that part of the curve also says there's no recession anytime soon.
Yeah. So I do think the yield curve, there's a little bit of a puzzlement. Why is the yield curve such a great recession warning indicator? Everybody accepts that it is, and it is. And the best answer that I've seen, and I think it's quite a brilliant piece of analytics, is it just tracks the output gap. The output gap tells you how much spare capacity there is in the economy. And so an inverted yield curve, or a yield curve that is now in the process of inverting, is telling us we have used up the spare capacity. We're getting into a situation where we've run out of recovery fuel. That means we're late cycle, and that's exactly consistent with what I was just saying. Very likely growth will be below trend by the middle of next year, and that basically means this will be an unusually short cycle. That's the message from the yield curve.
Christine, on the question of stagflation, are those commentators, those of us who are talking about the stagflationary risks, are they kind of slightly overblown at this point? What are you seeing that might point to an argument for stagflation?
Well, Tom, I think there's a little bit of debate now, definitely, in terms of whether we should be worrying about the stag part of stagflation or deflation part. And I think arguably what we heard from Jay Powell yesterday really emphasizes the fact that there are more inflationary impulses going on in the economy, not just in the U.S., but globally. I mean, we've seen, for instance, when we're parsing the impact of the war in Ukraine, I mean, that definitely has inflationary implications for the price of commodities. And so that's definitely something that's adding to already an inflationary picture that central banks were grappling with even before, towards the end of last year and earlier this year. And so I think what really drives home Powell's message, what that drove home, is the fact that there are a lot of inflationary worries in the economy at the moment, and that's definitely something that he's indicated the Fed will want to respond strongly to.
And Sebastian, we'll talk about equities, your wheelhouse, in a second, but overall, do you worry about stagflation, or can we avoid it?
I mean, it depends a little bit. I think it's a little bit of a fuzzy term. What do we mean by stagflation? If we mean growth is slowing and inflation is high, then very clearly we are in stagflation. What I find more useful when looking at individual...
Should I call it a stagflationary loop like we see in Japan?
I wanted to suggest a different framework. I think it's far more useful, instead of putting a big package onto the table, that we ask specifically what are the individual macro indicators doing in this environment, because typically equity trades and cross-asset trades are very sensitive to things like, is growth momentum slowing, is inflation going up or down, can the central bank still hike a lot? And I think far more useful is to say, what exactly do we expect these macro indicators to do, and then construct our portfolio.
Central banks will disagree, but we'll have that fight in just a couple of minutes.
Within, of course, the question about stagflation is the question of energy prices, and part of that complex, slightly detached, but still part of the mix, is nickel and the craziness that's been happening in the last few days as a result of the market gyrations there, closing, or falling, I should say, 9%, approximately around $28,000. There have been some, Christine, who suggested that $30,000 and below is a dip opportunity, at least a level for nickel where some may come back and start buying on the London Exchange. Just give us your take on what we're seeing here.
Well, yeah, Tom, I think there is a lot of volatility in the price given the events of the past week. But as we've heard from the LME CEO earlier in the program, they are doing their best to kind of try and bring stabilization to the market. And so it would make a lot of sense, you know, for dip buyers starting to see some opportunities here, especially as we see that kind of initial price jolt from nickel starting to fade away here once we get that stability back in the markets.
All right, Christine, thanks so much. Christine Aquino joining us, of course, from our Markets Live team, and Sebastian Reidler, Bank of America, head of European equity strategy, stays with us. Now, coming up, we'll get all the latest on the situation in Ukraine, the EU also discussing the potential Russian oil embargo. Plus, later on this hour, we speak to Mathieu Chabran, co-chief investment and co-founder at Tikehau Capital. This is Bloomberg.
Omicron variant and the latest wave have an impact on not only consumer trends, but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Welcome back to the Open. We are 15 minutes into your European trading day. Gains of 0.2% across the benchmark European stocks 600. Slightly more pronounced gains over in Germany, and the FTSE MIB in Italy gains of 0.6% on both of those indexes. Your 2-year yield, 10-year, I just want to draw this to your attention, 217 now, so a 5 basis point move as the Treasuries continue to price in the commentary that we got from Jay Powell. A more hawkish Jay Powell, leaving the door open to 50 basis points in May. Francine.
Yeah, no, oil had been surging for a 4th day on signs that the EU may be getting closer to a ban on Russian crude imports, but now reversing. If you look at what we're seeing for Brent crude falling to session lows as much as, I think, 1.5% lower. Let's get that price as we speak, because there has been a move in the last 10, 15 minutes or so. Differences in the bloc, of course, of the EU deepening, with Germany and Hungary putting the brakes on a potential embargo. Let's bring in Bloomberg's Europe correspondent, Maria Tadeo. So, Maria, thank you so much, as always, for your great reporting on the ground. The issue of banning Russian oil, hotly debated. Is it even actually on the table, a total ban?
Well, Francine, there's two things happening here at the same time that kind of reflected the price action yesterday, but today you see oil is coming back down, because the reality is there is no unanimity around this, and every major decision, as you know, Francine, very well has to be taken by the EU 27. So what we know is that the Hungarians have said we could veto this, especially, remember, Viktor Orban, the leader of Hungary, has an election coming up in 2 weeks. And then yesterday we also heard from the top European diplomat suggesting at this point there is no consensus around this. So if you ask me, are we going to see a full ban by the end of the week on Friday when European leaders talk about energy? The answer is probably no. But what matters here is that this is a debate that's back on the table. Remember, Francine, a week ago, the Germans completely put this aside. They just brushed it aside, saying we're not in a position to do this. But yesterday, when we spoke to foreign ministers and defense ministers, particularly those from Eastern Europe, they said this is a conversation that we are going to have. So they've put this back again on the table. So the debate is actually happening. This is not a story that has gone away in any way.
And a conversation, of course, that would have been unthinkable just a few weeks ago. What is the ability for the US president to get more unity on this topic?
Well, of course, you know that he's coming here on Thursday. This is a monster diplomatic push from the United States. They're doing a NATO meeting at G7, and then, of course, the big European meeting, which is also going to stretch into Friday. But a lot of this, Tom, we have to get real. It won't be a conversation about Europe. It will really be a conversation about NATO, how to strengthen the eastern flank, but also Ukraine. And the biggest question that both the European delegations and the United States are going to have to figure out is there even a diplomatic way way out of this. What we see right now is that the Ukrainian side is not moving, and when you look at the Russians, they still say the Ukrainians are not responding to our demands. So a lot of the conversation will feature, I would argue, on the diplomacy. When it comes to the energy, Tom, this is still very much a European conversation, precisely because there's no unanimity around it.
Maria, today on the ground in Brussels, following that debate, of course, around the prospects of a potential embargo of Russian oil. We are not there yet, but the fact that that conversation is happening, of course, important. Thank you. Let's bring back in Sebastian Radler, Bank of America, head of European Equity Strategy, still with us. Given what you were saying, Sebastian, before the break about your concerns about the trajectory of growth, and of course the conflict in Ukraine continues, we look at the equity space here in Europe, back to the levels that we saw before this invasion. Is there a complacency that is starting to set in across European equities at this point?
I think, Tom, you're queuing me up nicely. I think there is. I think the answer is yes. There's a big growth shock coming for Europe. It's very hard to quantify it, but we know that growth will be lower. In February, the run rate implied by the PMI for the euro area economy was 3.5%. That's simply not sustainable given this headwind that you get from high energy prices. A very easy way to illustrate that is gas prices and electricity prices in Europe are up fivefold over the past year. There are a lot of companies that are hurting. We see a lot of companies already cutting down production in paper making, steel making, in fertilizer production. And the question only is how much will growth weaken? And the number one driver of equity markets is the direction of growth. If growth is slowing, that basically means lower equities, and it hasn't sunk in yet.
But Sebastian, we also have quite a lot of major European companies that actually sell abroad, sell to emerging markets. So are you expecting a global slowdown for growth to a point where actually be selling off equities, or can you find pockets of growth here and there?
I do think the market across the board will be lower. I would say by around, it has around 10% downside, which only means it retraces the recent rally that it has done.
Sorry, what time frame? 10% lower?
Next 3 to 6 months, I would say. And it's really a question, how long will it take for this weaker growth to register and for the market to respond? And clearly there are some companies that will outperform and some industries that will outperform. And I think that these will be the defensive ones that are less affected by the earnings downgrades that will ensue. But nonetheless, the broad direction for the market from here is lower unless we find a magic potion to lead to a reacceleration of the European and the global growth cycle.
Where does that leave your positioning? Before this conflict, there seems to be something of a consensus, means the guests who came onto this show have said energy, financials. Do those trades still work? What are you looking at on a sector-by-sector basis?
Yeah. Obviously, one of the pleasures of my job is to be contrarian and to challenge this kind of consensus. So we've taken down our overweight in banks in the middle of February because we think that given this dynamic that we discussed before, there's only so far that central banks will be able to hike. We think we're close to the peak point of nominal bond yields. That has been the number one driver of banks, so we've already taken profits on that trade. Yeah. And we have a non-consensus negative view on energy. We simply think that in a slowing environment, growth environment, and against the backdrop of a strengthening dollar, the current commodity price level will not be sustainable. If growth slows, that will lead to weaker demand for commodities. It will register in prices, and obviously current levels are very elevated.
What about renewables?
They're within utilities, and they tend to be very defensive. They are also growth sectors, so they are very sensitive to the movement in interest rates. So if interest rates don't have much further to run and growth slows, then the whole utilities sector, including renewables, looks attractive.
All right, Sebastian, thank you so much. Sebastian Radler there, Bank of America, head of European Equity Strategy. Well, coming up, China grounds planes as investigators look to establish the cause of the nation's worst aviation accident in over a decade. We'll bring you the very latest next. This is Bloomberg.
welcome back to the Open. Let's check in on the stocks that are on the move with Danny Berger. Danny, what are you looking at?
Tom, in a rare change of events, I actually have some individual company stories. For once, it isn't macro over everything. Adidas on the move to the upside, up nearly 3%, moving higher in sympathy with Nike that exceeded expectations despite supply chain woes, despite issues with their China business outperforming. So it's Adidas, it's also JD Sport and Puma moving higher in today's session. CD Projekt, another one, the video game designer, saying that they have entered a 15-year partnership with Epic Games. Epic Games makes a graphic system. It's called the Unreal Engine. CG Projekt had a lot of issues with prior games because of glitches, but it's now going to use this for their new franchise called The Witcher, which I must admit I've never played. I don't play a lot of video games these days, but apparently it had glitches in the past, and now those are likely to be fixed, so that moving up 4%. Finally, Just Eat Takeaway signing an agreement with McDonald's. Prior, the delivery service had local agreements with different McDonald's franchises to deliver McDonald's. Now it's a global agreement, so we'll be able to do so more widely. So those shares up 2%, Francine.
Danny, thanks so much. Danny Berger there with your main movers. Now let's get the latest on the plane crash in China. Investigators trying to establish what made the Boeing plane carrying 132 people suddenly fall from the sky in the country's worst aviation accident in more than a decade. Well, joining us now is Bloomberg's Kyung Hee Park in Singapore. Kyung Hee, I mean, we really are not, the wiser about what exactly happens. Investigators trying to establish what happened. How long could it take?
Well, we're hoping that a briefing by the State Council investigation team later tonight will shed some light on some of the details that we are basically, hoping to get. We don't know what time the briefing will be, but we're hoping that that briefing will shed some light on what might have happened, when the plane crashed and other details like who the pilots were, how many hours of experience have these pilots had. There's been a lot of things going on social media right now, but we're hoping that we'll get some more sort of clarity on that later on.
Okay, Bloomberg's Kyung Hee Park on the latest on that crash in China and where things stand. We continue to keep across that story, of course. We're going to be focusing back on the commentary from Fed Chair Jay Powell after the break and give you all the price action, of course. Stay with us. This is Bloomberg.
Of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Powell crushes bonds. The Fed chair says he's ready for 50 basis point hikes if necessary, while short-end rates lead a global surge in yields. Oil slips from highs as the EU is divided over a ban on Russian crude. Moscow refocuses its attacks on the besieged city of Mariupol. Plus, inauguration day for Tesla's new factory in Berlin. It's a milestone in Elon Musk's efforts to challenge the European automakers on their home turf. Tom, if you look at the markets, I mean, we have a very different Jay Powell to what he was a couple of days ago. I guess 50 basis points was always on the card, but the market's suddenly realizing, and he just was so much more hawkish in terms of inflation.
Opening the door to 50 basis points, and absolutely on inflation, making it clear that for him, the risk was inflation versus the impact of growth, particularly around the war in Ukraine as a result of Russia's actions, of course. Goldman Sachs coming out saying, look, they're starting to look at 50 basis point hikes this year. Of course, we know that the dot plots are looking at additional 6 rate hikes of 25 basis points for the rest of the year. So the positioning and the pricing continues around that event. The futures leading up to today in the open European session were lower, but we're getting some modest gains at this stage of about 0.5% across the benchmark. The DAX is gaining 1%, 136 points. A decent move here for the German index. The FTSE 100 also up 0.5%. Let's see how things are breaking down on a sector-by-sector basis then. We had the sharp move lower in oil prices just in the last few minutes or so. We're trying to unpick what is behind that. But of course, the broader context is that most analysts, the consensus seems to be that you're going to get higher Brent WTI as a result largely of what is happening, the inflation impact, and then of course, what is happening around Russia and the debate that continues in Brussels about how far to go to cut that reliance and the time frame as well. In terms of the sectors, banks gaining 1.6%. The yield story will be part of that mix. We'll break that down in a second. Insurance also gaining, autos and parts as well. We were speaking to the European market strategist at Bank of America just earlier in the show saying they don't favor banks or financials at this part of the market. Energy, neither. But nonetheless, today you're seeing gains. Sectors that are losing, bottom of the pile, healthcare, it's a defensive down 0.5%. Let's look then at where the focus is for Jay Powell along the yield curve, because of course you have seen that broad flattening, but it's the 3 months and the 18 months. And that yield spread that he said in his speech yesterday was for him and the team at the Fed the most important. And there you have a significant buffer of about 240 basis points. And that suggests, if you buy into this view, that a recession is not on the cards, at least imminently. You've had examples of where that yield curve inverted before moments of economic distress, predominantly 2007 to 2009, and of course, pre-pandemic. That is not happening. 240 basis points in terms of that spread may be offering some comfort there to Jay Powell and the team, the FOMC, as they turn more hawkish, Francine.
Yeah, I really like that chart. I know our Mark Cudmore was trying to explain the nuances and the fact that we've had 13 years of loose monetary policy, and so we're looking at things that maybe are no longer relevant because of what central banks have been done in over a decade. Now, the bond sell-off deepens after Jay Powell said the Fed is prepared to hike rates by 0.5 point in May. That's if the move is needed to bring down inflation. Powell took the more aggressive tone in a speech yesterday at the National Association for Business Economics.
The expectation going into this year was that we would basically see inflation peaking in the first quarter, then maybe leveling out, and then see a lot of progress in the second half. That story has already fallen apart to the extent it continues to fall apart. My colleagues and I may well reach the conclusion that we'll need to move more quickly, and if so, we'll do so.
Well, to talk about the markets, investing in unusual places, we're now joined by Mathieu Chabran, co-founder of Tikehau Capital. Tikehau Capital is a global alternative asset management group. It's just announced plans to double assets under management to more than 65 billion euros by 2026. And Mathieu Chabran, we're very delighted, can join us in the studio today. So Mathieu, thank you so much for being with us today. We have 1,000,001 questions on inflation, on what it means for your private equity business and where you see money. Has it changed significantly because of these raw material costs, the fight the central banks are having with inflation, on where you want to be invested in?
Well, thank you, Francine. Tom, good morning, and thanks for having us here. A lot of questions, here, because we haven't seen yet all the knock-on effect, of the raw materials, but inflation was something we had, before all this situation, unfortunately, went out of control. And as much as these rate hikes is, in my view, long overdue, now they're effectively fighting and being a little bit caught between a rock and a hard place. So interesting times, for sure, but it's going only one way.
Okay, I mean, and Tikehau Capital is quite aggressive in terms of how much it wants to deploy money, where you want to be invested in, the capital that you want to attract. What do you think will be your best investment in the next 5 years?
I don't know if we're aggressive, we're certainly very selective, but there are, few parts of the market that in this environment, and that's why private markets have been benefiting from such, tailwinds over the past 10 years, and I think, can remain. And so today it's about avoiding duration risks, obviously, and it's also trying not to be into over-levered situation. And that's where, private market through direct lending, creating the yield, but yet mitigating the interest rates rise, because we do floating rate. Long-term sell and leaseback real estate, where leases, are indexed. Growth capital, particularly, for all the mega trend, energy transition, cybersecurity, all these, topics that are emerging on the back of this situation, that will be great investment opportunities.
AUM of about 30 billion euros at the moment, the target for 65 billion. That target certainly is aggressive. What would that level or that AUM allow you to do that you can't do now?
Well, it's really, today our job is to be, is to transform global savings, which have been growing on the back of very accommodating monetary policy, and directing the savings into the real economy, where it matters, okay? And that's what we're seeing today. So it's not about raising assets for the sake of raising assets, it's that there is a lot of demand from global investors, asset allocators, and on the other side, particularly in some troubled and shaken markets like we have, from corporates, entrepreneurs who need to get this capital to grow. I mentioned energy transition, that's one area that only private market will be able to address in the in the short term.
But now it's public policy. I mean, the EU wants to come in and do renewables. So are you going to be fighting, on some of the projects with the EU?
No, we're not fighting. We're working together, actually. Right. And that's where, private manager, that's where, private allocators have to effectively leverage all those initiatives that are being, launched by states, by EU, and trying to be their partner on that together with private money.
In terms of that energy transition then, in an environment, of course, where you have the conflict continuing in Ukraine, you have these very high energy prices, and then, of course, you've got the central bank tightening. What does that mean for the private equity part of the business specifically, that changed environment?
Yeah. So how do you define private equity? If it's about, the buyout, the big LBOs, companies who've been effectively over the past few years maximizing leverage, that's an area of the market that could effectively concern me. Where I see the opportunity for private equity is effectively, and particularly in Europe, where companies are undercapitalized, is to use this private capital, expansion capital, working with entrepreneurs, families, who need to grow their business, take advantage of consolidation. Sometimes, if effectively they've been suffering from pandemic, they need to reinforce their equity base. That's a great area, to invest, because those people are not leverage junkies.
I know, but if you look at inflation, it's going up. I mean, it's a hard environment to do business. So does it mean that you can scoop in things for cheap, or is it actually just much harder?
I don't think, obviously some people will try to take advantage of stress situation, distress situation. We're not here to time the market. I mean, we're effectively here to provide long-term, flexible, patient capital to companies who need that, and that sometimes public market can't offer. You saw that, Q1 was very weak in terms of IPO pricing, in terms of, debt issuance, and that's where private markets can take advantage of that.
What is debt origination looking like, that part of the business?
So it's really, the mid-market area. So people in Europe doing 20 to 100 million of EBITDA, right? And they cannot access the public market because right now it's becoming much more selective. And yet they need this long-term, funding and resources. And we can tailor that, in a very bespoke way, because that's what our investors are looking for: long-term, recurring, yielding investments.
Are you seeing any stress there? Any concern about defaults?
So certainly not default yet. The stress is always about, working together side by side with your borrower, with your company, to anticipate and to not to be in reaction, to some situation. And that's where we tend to be the private market manager side by side and not face to face, with your borrower.
All right, Mathieu, is it nice to be in a nice time zone? Because he usually wakes up at like 4:30 in the morning for us. So it's nice, right? You feel refreshed. Yeah, it's nice to have you in London.
Great to be back here.
Mathieu Chaperon, co-founder of Ticoho Capital, stays with us, and we'll talk a lot more about some of these rising energy costs, what it means for some of the investments, and of course the read across 5-10 years from now. Coming up, the UN says nearly 10 million people have been driven from their homes in Ukraine. We'll get the latest on the ground across the border in Poland. That's coming up next, and this is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open. We are 43 minutes into your European trading day. Gains across the stock 600, the benchmark of 0.4%. Top of the list with your sectors is banks gaining 2%. You've got your US 10-year yield at 2.33. Okay, US President Joe Biden has said that Russia's use of a hypersonic missile against Ukraine is a sign that Putin is growing desperate. Meanwhile, the UN reports the invasion has driven 10 million people. That's nearly a quarter of Ukraine's population from their homes. Let's bring in Bloomberg's Aggie Cantrell. Aggie, what is the situation then on the ground in Ukraine as things stand?
So what we're seeing, Tom, is a huge amount of people who are fleeing their homes within the country. It's important to acknowledge that while the Ukrainian government is dealing with the war itself, they're also dealing with a humanitarian crisis in their own country. As many people flee, especially the east of the country, we've been seeing the images out of places like Mariupol that's been under siege since March 2nd at this point. And a lot of those people have tried to flee outside these eastern areas into places like Lviv, and then potentially also over to Europe. And where I am here in Poland, still a steady flow of refugees have been coming over the border from Ukraine every day that I've been here since the war began, really. And what's important to see is how Poland is now looking at integrating these people into the labor force, into the education system. And once they're here, it's important to see where they can go next. There's already a huge amount of people who have moved to Warsaw and to other European countries as well. And that's a key concern for the European Union going forward, is after getting these people over the border, how they're able to find places to live and work more securely.
Or yeah, and a lot of the things actually that we're seeing is really from, I guess, individual families without really government scheme in a certain place. I'm thinking about the UK. Aggie, thank you so much. Aggie Cantrell there at the border of Ukraine. Now, we're back to talk about some of the economic impact that the war in Ukraine has had on raw materials, inflation, and of course, the longer term strategy for energy security. We're back with Mathieu Chabran, co-founder of Tikehau Capital. Mathieu, first of all, thank you so much for sticking around. But one of the things that you have been really focused on is on renewables. And you were telling us, like, this is not only private money, it has to be in partnership with public. But it seems that the timeline, and if the EU says, look, in 2 years, we're no longer dependent on Russian gas, the timeline is a real problem. Like, how fast can we go? And what do you need to really accelerate? Like, we don't really have the technology, and it's certainly not cost effective.
Yeah, Francine, if we step back, before this crisis, we already only had 3,000 days to get to, and to meet, the goal of the Paris Agreement, and for the decarb objectives. This situation, as dramatic as it is, is effectively putting even more pressure to speed up, this transformation. And if there is a silver lining to what's happening, that's probably where it is. Obviously, we're still dependent on some oil, on some gas, and all this trade that we have with Russia. But if collectively that can be a catalyst to effectively accelerating that, because it's not about inventing what we're going to need in 10 years. It's about taking what we have today to invest more, to massify, to scale up, to level up effectively, this alternative source. And that's where I see, some hope, if I may say, that we move from the greenwashing to effectively allocating real money into this transformation.
So where specifically within renewable energies do you want to be focused at this point? Where can you really monetize and get the gains that you need, as well as propelling this transition?
It's first and foremost, Tom, I think, upgrading what exists. So take, for example, building efficiencies. That's 40% of the carbon emission, right? So you take all the buildings, be in London, in Paris, in Frankfurt, in New York, and then you start working on that so that you no longer, throw some energy out of the window, if I may say, but make sure that the way you consume is much more efficient. And so it's about taking, all this, and then you get into, obviously, the solar, the biomass, some alternative source, but start with things that exist and just need to be upgraded.
I mean, we had this huge debate in the newsroom yesterday about energy storage and the fact that actually we talk about it as it's done, but there's so many components that still really need to be ironed out. I mean, the other question is we're consuming coal more than we have in the last 5 years. So does it worry that we actually can, may move away from our goals as we need to transition fast away from Russia?
No, I don't think, speaking about, energy storage, I'll give you an example. We invested in Italy in a great company doing some electrical batteries, some rotor and stators that, for the past, 40 years were only used for mechanical, effective batteries. They pivoted and transformed all their production line. And now it's not just about, the Teslas of the world. It's about the traditional automotive constructor, moving them. Absolutely. And that's a very point, Francine. It's about scaling, massifying some existing product that then can effectively take over, from more traditional.
We've stopped talking about the pandemic. It's still there. COVID-19 is still there. Infection rates in the UK are ticking up, in fact. I want to talk about the real estate, how that overlaps with the real estate investments and how that has changed. Do you still want to be investing in hotels, in office space? What are you looking at when it comes to real estate?
Yeah. So yes, we're still very much, invested. At Tikehau, we're managing, 10 billion of real estate across commercial real estate, part of the retail, but also residential. More and more. We just completed a very big transaction in Portugal, for example, on the residential space. So there are two angles here. It's transforming real estate, part of that, and we did, a couple of transactions in London. One in the outskirts of London, which was more like an industrial site, to transform and upgrade. The other one is on Pall Mall, very prime, but that's when, some investors are walking away, because of the Brexit, let's say, and effectively stressed a little bit by the pandemic. And that's where at Tikehau we like to be a little bit contrarian. It's a supply demand, and, I feel very good transforming a building on Pall Mall.
What about SPACs? I think it was like the buzzword 2 years ago, a bit like the Kardashians, and then they've kind of run out of fashion. The millennials will hit back saying, no, the Kardashians are still in. What's happening to SPACs?
I know you like talking about SPACs, and who we partnered with, with Jean-Pierre Mustier, Diego Di Giorgi, Financière Agache. We raised 3 SPACs last year. 2 in Amsterdam, 1 in Singapore. We were, one of the first batch in Singapore to do that. Here again, create, not compete. The US market, and I'm based over there, as you know, it was crazy. Way too many money being raised. In Europe, less so. And at this time where the market is effectively softening for the IPO market to get access to long-term capital, over the past, couple of months, we've seen an increased number of discussion, again, with entrepreneurs. A SPAC is not buying a company, it's giving access to a private company to the public market. So yes, we're still very much there. I'll tell my partners that you call us a Kardashian. I'm sure they'll enjoy that.
They're gonna love it.
Yeah, they're gonna love that.
Yeah, I'm getting a lot of flack from the newsroom saying the Kardashians are still in.
Yeah, they are not walking back from this. It's all about the Kardashians. We're just moving on from the celebrities for the moment and the SPACs. Just last question, I think we're running out of time.
Yeah.
Your regional preference, as you have this expansion plan, you want to double your assets under management. Yeah. Which countries for you offer the most opportunity? Where are you going to be focusing your attention regionally?
Yeah, Tom, I mean, we're first and foremost, a European player, and we expanded in Asia 5 years ago. I'm now based in the US, for the past 4 years. These 2 markets have been big, engines, to our overall growth. We're expecting that to grow. We are announcing this morning we're opening our first office in Israel, in Tel Aviv. That would take, 13 offices worldwide. And for us, it's effectively about, being local. I mean, here in Europe, big question mark, obviously, because we're probably at the core of this whole situation. Yeah. The US have been booming, as you know, maybe a bit overheated, and this inflation, will be something to address over there. And then in Asia, always, a complicated zone to address if you're not local. That's why, we were down there in Singapore, in Korea, in Japan, and we see all these zones extremely interesting.
We need to get you back to talk about China and also to talk about some of the other things that actually we should, including Latin America. Mathieu Chabran, thank you so much for joining us, co-founder there of Tikehau Capital. Now, coming up, Tesla is set to open its new factory outside Berlin today, bolstering the car maker's push to expand in Europe's fast-growing EV market. We'll have all of the details, including Elon Musk's tweet. I'm obsessed. I feel like it's the last thing I read before going to bed and the first thing when I wake up. Maybe I need a doctor. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. Now, after months of delays, Tesla is due to inaugurate its new factory in Berlin. That's happening today. The long-awaited opening is a boon for Tesla CEO Elon Musk, who plans to challenge the European automakers on their home turf. Joining us now is Craig Tudell from our Autos team. Why is this such a big deal then, Craig?
Right, so we have 2 factory openings for Tesla this year. This factory in Germany and another one in Austin, Texas. This is the much bigger deal of the 2. You don't have local production in Europe to this point. A lot of cars coming in from California and from China. There's a lot of logistics costs in there. The ability to have production closer to where demand is going to be is a massive deal for them. And this is also just a case where the EV markets in Europe are just growing at a really substantial rate. So for Tesla to be able to localize production, bring costs down at a time when cost pressures, we should mention, are up in a lot of respects for EVs and batteries, this is a big development for them.
I know we have to talk business. I want to talk about the tweets because he's out of control. Although I did see actually that the factory open made it onto his tweets. I mean, what is Elon Musk now? It seems like he's a machine on his own, 11 million followers. Does it actually help, at least in terms of marketing, to see that he's different from other manufacturers?
He always is getting
Larger
attention,
than life,
right?
yes.
And I mean, he's as big as Tesla. I think that helps with a lot of people where they are really they really gravitate toward him and the brand. It hurts with others when he does things like post about Justin Trudeau and Adolf Hitler. I don't think that particularly probably went down well in Germany. But he is always in the conversation, put it that way. And I do think that sort of builds his brand and keeps Tesla top of mind for people.
Just in 10 seconds, what are you hoping he might answer today?
Just the shape of the ramp up in production. How quickly can he get to scale? He talked about last October getting to 5,000 to 10,000 vehicles by the end of the year. There's a big difference between those 2.
Craig Tudell, thank you very much on all things Tesla and that opening of the factory in Germany. That is it for your European market open. The markets across Europe gaining 0.4%. Surveillance Early Edition is up next. This is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think risk assets are scared. It's in the price now, but also I think now it could also get a bit more balanced.
Where is inflation going to settle? How far is the Fed going to raise rates? And what's the outlook for growth?
Some signs of that uncertainty is starting to ease. We might be past the peak point of uncertainty.
I think defensive is the way to go. You know, I'm still a big believer that the physical global economy continues to motor along.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, March 22nd. Our top stories today. The Fed chair takes a more aggressive tone toward inflation. Jerome Powell is ready to raise rates by a half percentage point in May if it's necessary. That led to one of the worst days in decades for the U.S. bond market. U.S. Supreme Court nominee Ketanji Brown Jackson is set for questioning by a Senate committee. She's told the panel she's an independent thinker who decides cases from a neutral posture. And President Biden warns that Russia may strike back. He told the private sector they should be prepared for Russian cyber attacks and called the Kremlin's use of hypersonic missiles a sign of desperation. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines over in New York. And Kaylee, incredible moves in bond markets, a real move to the upside, real move higher in bond yields, and yet equity markets kind of taking that in their stride.
Yeah, absolutely, Anna, and that was definitely in the case in Asia overnight. Broadly, it was an up day for the benchmarks there. The MSCI Asia Pacific Index as a whole was up by about 6 or 0.7%, actually nearing more than 1 percentage point at this point. One of the big outperformers within that was Hong Kong. That was a move led by technology stocks, specifically by Alibaba. That stock was up more than 11% overnight after it hiked its buyback program to $25 billion, the second time it has boosted that program in the last year. So a sign of optimism for that company, maybe on the easing of the regulatory crackdown. Other outperformers when it comes to equities include those in Japan, and partially that was due to the weakness of the Japanese yen, the big underperformer in Asian FX, weaker against the dollar by 0.8%. We are through the 120 level, which is somewhere we have not been since February of 2016, so the weakest yen going back more than 6 years. And finally, as Anna was saying, you are seeing that selling pressure in bond markets globally. It started with treasuries off the back of that hawkish commentary from Jerome Powell yesterday, but it continued in New Zealand and in Australia overnight, specifically at the short end of the curve. That 2-year yield in Australia up 17 basis points, more than a 3 standard deviation move. It is at the highest in about 3 years, Matt.
Yeah, I think that the yen move is particularly of note, especially for automakers that need to buy so many parts and supplies from Japan. Take a look at U.S. markets. S&P futures are up about 0.4% right now, so it's a risk-on day. Investors are letting go of bonds, and the 10-year yield is rising to 234.05. We should note that that is lower than the yield on 7s, 5s, and 3s. and right now just about 15 basis points away from the twos. So watch it closely. The twos have been incredible rally in yields, sell-off in the debt. NYMEX crude right now at 111, so coming down little less than 1%, but still at a relatively high level. And oil has been one of the thorns in the side of Jerome Powell and the Fed in terms of inflation. So they're, I'm sure, happy to see that come down a little bit. Bitcoin gaining 3.4% to 42,535. This just signifies that it's a risk-on day because Bitcoin has been so correlated of late. Anna, what are you seeing in Europe?
Well, Matt, we see a risk on day here in Europe, but it didn't start off that way. Certainly the futures picture through the Asia session was signaling that we'd see something flat to negative for European stocks, maybe negative in the US as well. But oil prices were higher then, and oil prices have actually retraced quite a lot in the overnight session from earlier highs. More on that in a second. But this is the FTSE 100 up by 0.6%, the CAC 40 up by 0.3%, the Xetra DAX up by nearly 0.9%. So a real turnaround in sentiment here on European equity markets, and all of this in the face of those higher yields. The Kaylee was talking about through the Asia session, and clearly, obviously, emanating from what Jerome Powell had to say yesterday. This is Brent crude. 114 is the start of the Brent price right now for a barrel of Brent crude oil. It was 119 a little bit earlier on in the Asian session, and so we were up by a few percentage points on the oil price once again. We were headlining that story earlier on in our programming here in Europe, but we really turned around that particular picture, the oil picture looking a little less, making moves lower in this morning's session. Nickel, worth noting as well, down by 9.8%. That is not the limit to which it was able to go today. It could have dropped by 15%, but we're actually seeing trading. We're seeing buying and selling happening in nickel prices on the LME as we've seen this price come down to more where it is in Shanghai, which is a market that was open through all of this short squeeze that led to a closure of the markets here in London. We'll bring you our conversation with the LME CEO a little bit later on. That's really interesting. Euro dollar 110, a lot of strength in the dollar. We talked about that going hand in hand with higher yields in treasuries, and we did have some euro weakness, a little bit more euro weakness earlier on in the session. And I put in here Adidas, this one for Matt, of course, who likes to keep across those German names perhaps still. And we saw Adidas, of course, responding to what we heard from Nike, that better than expected result coming through from Nike, maybe getting through some of the supply chain issues, Kaylee, that playing well for them and seems to be playing well for European peers as well.
Yeah, absolutely. And we will have more on Nike in just a minute, Anna. Great look at Europe there. We also wanted to mention something about Russian assets. The Russian finance ministry says it has paid a $66 million Eurobond coupon in full. We will continue to keep you up to date on those bond payments as creditors really look to see whether the country is going to continue to meet its debt obligations. Now a look at what else is ahead today. It is day one of the Bloomberg Equality Summit. Speakers will include San Francisco Fed President Mary Daly, as well as Macy's CEO Jeff Gannett. ECB President Christine Lagarde and the New York Fed's John Williams will be among several notable speakers at the BIS Innovation Summit. And after months of delays, Tesla is due to inaugurate its new factory in Berlin. Matt Miller is in New York, so he won't be there, but Elon Musk will be in plans to challenge the likes of Volkswagen and BMW on their home turf. And finally, later on this morning, we have an exclusive interview with St. Louis Fed President James Bullard at 8:30 a.m. New York time. Will be really interesting to hear from him after we heard from Powell yesterday, Matt.
Yeah, absolutely. Clearly the most bullish member of the governing committee. Now, the bond sell-off is deepening after Fed Chair Jerome Powell struck a more hawkish tone on the central bank's campaign against higher inflation.
What I've said is that if we think it's appropriate to raise 50 basis points at a meeting or meetings, we will do so.
Bloomberg's Andy Berger joins us for more, and it's really been incredible, right? I just looked at the Bloomberg U.S. Treasury Index down almost 5.6%, making it the worst quarter since at least 1973.
Yeah, and that destruction continues today. The surprise was all yesterday, which I should say, the bond market surprise to Powell saying we could see 50 basis points in itself is kind of a surprise because the Fed had adopted this posture of fighting inflation at all costs. But that selling, the fire in the bond market continues today, led by the front end of the curve. The two-year yield easily blowing past 2% at 2.18 at the moment. So this is a yield curve where the belly of the curve is seeing a lot of inverting, a lot of concerns about will the Fed break something? Can it engineer a soft landing? Well, we're also starting to see more bets of 50 basis points. It's baked into the picture for May in terms of if you look at Warp Go and your terminal. Goldman Sachs says it's not just May, it's going to be the following meeting as well that sees a 50 basis point hike. So all of that combined does get a curve, at least in the 2s, 10s, that is closer to inverting. That's the chart I have up for a radio listening audience. So 2s, 10s now just around 16 basis points, but Powell himself in that conversation said that it's the front end, it's the 18-month curve that he is looking at. If you look at 3-month to 18-month T-bills, which is the other curve I have up here on my chart, that has actually been steepening. It's around 250 basis points. So if this is what Powell's concerned about, if he's watching the market for reaction for odds of recession, he has a lot of runway to tighten before we get more inversions.
Yeah, absolutely. He was not thinking 2s, 10s, not 5s, 10s. He wasn't thinking 2s, 30s or 530s or any of the other curves that are available. He was thinking about that 18-month futures spread, which you point out there, Danny, tells a very different story. It is steeper and gives him room to move. What about oil prices then? We've seen a lot of volatility in oil prices through the Asia session into the European session this morning, Danny.
Yeah, it was remarkable. At one point, we were up some 4% today. That's completely reversed. We're to the downside. Now, we are getting closer to that peak reached earlier in the month. We're about 7% away from that, given we've rallied about 18% in the 3 days prior to today. But today's turnaround just really underscores the volatility in this market. Now, of course, it's driven by headlines. It's driven by headlines of Europe potentially looking at a Russia energy ban this morning. That helped it move higher. But there's also a lot of liquidity problems in this future market. Bid-ask spreads have been really wide. So that often leads to this volatile trading like we had today. Of course, it goes just beyond the futures contracts and the volatility and the liquidity. It also has political implications. Of course, it's something that Fed Chair Jay Powell is worried about, but it's also something Biden has worried about as well. A really great scoop on the terminal from the Bloomberg News team that President Biden's aides have encouraged him to thaw out some of the relations with Saudi, that it's not in the U.S.'s best interest, because if they don't have Russia oil anymore, they might have to be turning to Saudi. So that is something that's taking place behind the scenes, according to people familiar. However, those reports also suggest that Mohammed bin Salman, he, on his end, is not ready to play along that.
Yeah, not taking the call just yet. And those inflation effects hitting other central banks as well. I said James Bullard, member of the governing committee, which is so embarrassing. I'm so European, right? That's an ECB thing. What I meant, of course, is one of the most hawkish Fed presidents. Danny Berger, thanks very much for joining us. Bloomberg's Danny Berger. They're looking at the big moves in oil as well as bonds. Let's get over to D.C. right now into politics. Judge Ketanji Brown Jackson told a divided Senate panel she was an independent thinker who decides cases from a neutral posture. Jackson began testifying at a hearing yesterday on her nomination to be the first black woman to serve on the Supreme Court. We get more from our Washington correspondent, Joe Matthews. So, Joe, what do our chances look like right now?
Chances look great. I think most everyone expects that Ketanji Brown Jackson will be confirmed, but she's got a couple of potentially tough days ahead. Yesterday, this 4-day process opened up with the formalities, the introductions, but actual questioning begins today, and it's going to be a long session that will likely bleed into tomorrow. There are 22 members on the Judiciary Committee, Matt. Each will get 50 minutes each to question Judge Brown, and we got a little bit of a sense of where this is going to go yesterday with opening remarks from the likes of Senators Ted Cruz, Josh Hawley, some of the other Republicans on the panel, including Lindsey Graham, the former chair of Judiciary, who were really hitting home on not only judicial philosophy, which she says she doesn't really have, but some of the other issues that they'd like to get into her record as a public defender, defending, for instance, Guantanamo Bay detainees. They're trying to paint a picture of her being a bit soft on crime, which might last for the balance of the next 2 days. But still, when this committee votes on Thursday, she is expected to be confirmed on the committee, and then it would go to the full Senate.
All right, Joe, that's on the domestic front. Let's turn to foreign affairs, because President Biden says Russia's use of hypersonic missiles against Ukraine is a sign that President Putin is growing desperate. Take a listen to what he had said yesterday.
If you notice, they've just launched their hypersonic missile because it's the only thing that they can get through with absolute certainty. He wasn't anticipating the extent or strength of our unity. And the more his back is against the wall, the greater the severity of the tactics he may employ.
And Joe, President Biden went on to warn of potential cyber attacks, Russia attacking U.S. companies, asking them to lock their digital doors, play defense. Is there any sign of more offense coming from the administration and potential retaliation?
That's a good question. Evolving intelligence was the term that the White House used yesterday as we talk about the possibility or even likelihood of a cyber attack, not against Ukraine, to your point, against the U.S. It's unclear exactly how the Defense Department, how the Biden administration would interpret such a move. So they are, in fact, going straight to companies. We understand the federal government has briefed about 100 companies on this. It's really something, too. We're not talking about very advanced technologies. They're asking that companies simply encrypt sensitive data, which you would think they were already doing, and to provide double authentication, which a lot of people have for their basic personal email accounts. So corporate America is being asked to harden defenses because Putin is looking across the ocean now to the U.S. With regard to that hypersonic missile, indeed, the administration is very concerned that as this enters a stalemate, Russia will start using more destructive, longer-range weapons against Ukraine, and that is what it appears to be the strategy right now.
Joe, thanks very much. Bloomberg's Joe Matthew. You can listen to Joe every weekday on his radio program Sound On. That's at 5 p.m. Eastern Time on Bloomberg Radio. Let's get to some breaking news. We've just seen across the Bloomberg the EU is to work toward joint gas purchases. This is according to a draft summit statement of an EU leaders summit that is set to take place this week. EU leaders may endorse taxing windfall profits of energy firms. Let's put that into the mix with other news lines that we've heard around energy with our European correspondent Maria Tadeo, who joins us from Brussels. Now, that was about gas. That's about joint gas purchases. The news that has moved markets this morning has been around oil. Oil has pulled back a little bit from its earlier highs, but tell us what we know about the politics here, Maria.
Well, Anna, when it comes to the breaking news that you referred to, this is a proposal that was actually pitched by the Southern Europeans, including my home country, Spain. They've been pushing for this for weeks to try to get something that looks like a joint European response to the prices that we've seen that are now very much translating to consumers. A lot of this has to do with perhaps joint purchases, joint storage. So all of this is featuring now into what is a domestic conversation in Europe about how to bring down bills. Now, the other big issue, of course, has to do with Russian imports. Now, we've seen so far the European Union saying, no, we're not in a position to accept that. But Anna, what we know is that this debate is very much back on the table, and it's been brought back on the table by the Eastern European countries, the Baltics, the Polish. All of them say we really need to hit Russia where it hurts. And that, of course, is the energy sector. What I would say, however, when I speak to European diplomats behind the scenes, they say right now it's a complicated picture. And the reality is we don't have unanimity on it. Every major decision by the European Union has to agree by the 27 countries. And we're looking at potentially a veto from Hungary, from Viktor Orban, who is facing re-election in 2 weeks' time. So the question is, are we going to see anything that looks like a full ban? You know, my sources will tell me not this week, not by the end of this week.
All right, Bloomberg's Maria Tadeo. Great reporting, as always, from Brussels. Now, Ukrainian President Vladimir Zelensky says the nation would hold a referendum on the terms of any potential peace agreement. But right now, peace is still out of reach, and the humanitarian crisis due to the war is ongoing. The invasion has driven 10 million people from their homes, according to the United Nations. Let's get more with Bloomberg's Aggie Cantrell, who joins us from a humanitarian aid center in Poland. Aggie, what are you hearing from the people, the Ukrainians that you speak to, about their optimism or lack thereof when it comes to a potential peace agreement?
It seems that at the moment, the peace agreement, it feels pretty far off for the people who've left their homes. A lot of the people who've come here were already internally displaced within Ukraine. They're from areas under heavy bombardment. And this is also important to point to the tactics that the Russians are taking at this time, where we see that they haven't managed to encircle the capital, Kiev. They haven't been able to really gain that major foothold there. And so they're refocusing to places like the east of the country, around Mariupol, the port city, which has been under bombardment since March 2nd. And this seems to be a tightening or a narrowing of the Russian military strategy so that they remain focused on the areas where they could really gain ground in those places and secure that long sought-after corridor between Russia and Crimea. And so that's a key focus for them. And then when you look at what President Zelensky was saying, he was saying that while there may be a commitment on Ukraine's behalf to not join NATO, that would need to come with a ceasefire and would have to be part of a peace agreement that was then held as a referendum for the Ukrainians to take. He's not willing to do that without the say-so of Ukrainians to make sure that this is more of something that will go forward even past his presidency.
Well, and of course, you need an agreement first. Thank you so much to Bloomberg's Aggie Cantrell in Poland. Now, let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. I wanted to check on shares of Boeing because, of course, it fell 3.5% yesterday after that China Eastern aircraft crashed in Southwest China with 132 people on board. That was, of course, a 737-800 NG model plane. Unclear to this point what caused the crash, but right now China Eastern has grounded its entire fleet of that model of aircraft. Right now, Boeing is steady in early hours, essentially unchanged in pre-market trading. One stock sinking to the downside, though, is Okta. This is a software application company, helps with authentication services for thousands of companies. It was reported overnight that they were investigating a data breach. The company's CEO now out saying that there was an incident in January. There's no ongoing signs of malicious activity, but still investors are selling those shares. It's down the better part of 10% in early hours. One mover to the upside, though, is Nike. It reported after the bell yesterday. Sales beat across all regions, including in China, where, yes, business is weaker, but sales didn't fall as much as expected. So that stock getting a nice lift in early hours, Anna. It's up about 6% before the bell.
Yeah, and that story has moved across the Atlantic to European rivals. Now, coming up on the program, Christian Müller-Glissman joins us, Goldman Sachs Managing Director for Portfolio Strategy. What does he make of stock resilience in the face of the bond market sell-off? Let us also talk about Ukraine, of course. Aricia Lutsevich joins us, Research Fellow in the Chatham House Russia and Eurasia program. We'll get her expertise on what we're seeing. Really fascinating, this idea of putting any deal with Russia in front of the Ukrainian people, if indeed a deal could be reached. And don't miss our new show, Bloomberg Crypto, airing today and every Tuesday at 1 p.m. New York time. Join Matt and Kaylee there today. They'll be hearing from the author and notable crypto skeptic James Rickards, as well as Perianne Boring, founder and president of the Chamber of Digital Commerce. This is Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
has the Fed covered all week. Today, an exclusive interview with St. Louis Fed President Jim Bullard.
There's just risk out there, and markets are going to have to price that risk.
Tomorrow, an exclusive interview with San Francisco Fed President Mary Daly.
Balance sheet policy is just another part of our policy toolkit.
The most in-depth coverage and analysis of the Fed.
Which meeting matters?
Every meeting matters.
Continuing coverage this week on Bloomberg Television and Radio.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on Bloomberg Radio and on Bloomberg Television. I'm Matt Miller here in New York with Kaylee Lyons, Anna Edwards with us out of London. Now, our producer in London, Valerie Sarasulo, put together a packet of charts today that was so good, I feel like bankers should be able to subscribe to her work. This is probably the simplest chart that she included, and for our listeners on radio, what I'll tell you is that we're showing the 10-year Treasury yield going all the way back to the 1980s. In 1984, when Prince came out with When the Doves Cry, the bull market started, and it's gone 40 years now. The question is, are we finished with it now? We're seeing it move out of a range here. Lynn Thomason joins us, Bloomberg Markets managing editor, to talk about what this means for markets. We've just had the worst quarter for treasuries in my lifetime, Lynn, and I'm very old. So is it over?
Oh, that's a good question. I mean, it certainly seems like, the market action today is clearly a sharp sell-off in bonds. And I would just add, I think the other interesting aspect of that is that everything is moving together. This idea of a 40-60 balanced portfolio where some assets go up, some assets go down, doesn't really seem to be working out right now. And we're continuing in this scenario of everything goes up or everything goes down, which I think makes it very difficult to manage.
Well, stocks are moving up today, aren't they, as bonds move down? But I appreciate that's a very short-term perspective to take. I mean, where have we come to after yesterday's words from Jerome Powell? Because some people are surprised that what he said was such a surprise to the markets, but it did seem to surprise many in the bond markets.
No, absolutely. Clearly, some sharp moves we've seen in the bond markets. And I think, a lot of strategists that we've been talking to say, this just increases the question of, are we going to see a recession? Are we going to come into stagflation? And how do we manage that issue?
All right, Bloomberg's Lynn Thomason, have to leave it there, but thank you so much for joining us. Now let's keep you up to date with other news from around the world. Here's the first word. The Omicron subvariant BA2 is continuing to gain ground in the U.S. That's according to COVID test results from the last 2 weeks. The genomics firm Helix estimates that up to 70% of all coronavirus cases in the U.S. are BA2. Investigators are trying to figure out why a China Eastern Airlines Boeing 737-800 suddenly fell from the sky. The crash in the southwestern part of the country is believed to have killed all 132 people on board. Air crash experts are baffled at the plane's nosedive from 29,000 feet. Meanwhile, China Eastern grounded its fleet of 737-800s. And Alibaba has ramped up its share buyback to $25 billion. China's e-commerce giant is reacting to a $470 billion loss of value during Beijing's internet crackdown. The government has pledged to support the economy and finish the clampdown on the tech sector as soon as possible. That triggered a historic rally in Chinese stocks, Anna.
Coming up on the program, Christian Muller-Glissman, Goldman Sachs Managing Director for Portfolio Strategy. We'll get his perspective on what we're seeing in bond markets. We've already heard that Goldman Sachs now sees 50 basis point hikes in both the May and the June meetings. How does that sit with balance sheet runoff? Lots to discuss then. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Fed chair takes a more aggressive tone towards inflation. Jerome Powell is ready to raise rates by a half percentage point in May if it's necessary. That led to one of the worst days in decades for the U.S. bond market. U.S. Supreme Court nominee Ketanji Brown Jackson is set for questioning by a Senate committee. She's told the panel she's an independent thinker who decides cases from a neutral posture. If confirmed, Jackson would become the first black woman on the court. And President Joe Biden is warning the private sector, improve your defenses against cyber attacks immediately. The president says the Kremlin may be plotting cyber attacks to retaliate for sanctions imposed after the invasion of Ukraine. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Matt, European equity markets, they're perhaps a little stronger this morning than we'd anticipated just a few hours ago. What are you seeing pre-market in the US?
Yeah, well, we see a risk-on picture in the pre-market here as well. Take a look at S&P futures, up just 0.25%, but a gain nonetheless. You have the 10-year yield. Investors feel comfortable enough to let go of the perceived safety of government debt. I love that phrase. Up to 234.78. I will point out that we see higher yields right now on the 7s, the 5s, and the 3s. So you've seen an inversion in the belly of the curve, as another great piece of jargon for you this morning. New York crude down below 110 a barrel now, 109.70. So it's coming down more than 2%. And Bitcoin rising up more than 3% now, 42,452. Just another risk-on signal. Kaylee, what are you seeing in the pre-market?
Well, one big mover I'm paying attention to is Okta. This is an application software company, authentication services that it provides for many companies. And there was reports overnight about a potential digital breach. One hacking group did take credit for it, but the company's CEO saying that there was an incident back in January. There's no ongoing sign of malicious activity. Still, though, that stock is down about 8 or even almost 10% now before the bell. I wanted to pay attention to Boeing as well because, of course, we're continuing to follow the story after that 737-800 NG crashed in southwestern China yesterday. The stock was down 3.5% on the back of that. Investigators are still looking for an answer as to why that happened. Right now, Boeing shares recovering just slightly from yesterday's losses, up about 0.3% in early hours. I wanted to point to Tesla as well because its Berlin factory is being inaugurated today. The Model Ys made in Germany will start rolling off the production line. That stock is up 1.4% before the bell. And finally, paying attention to Nike as well, beating across the board, sales on all regions coming in higher than expected. It's working through a lot of those supply chain challenges as well as weakness in China. So as a result, that stock is up nearly 6% before the bell, Anna.
Absolutely, Kaylee, and I'll start at the bottom of my board as a result of you focusing there on Nike. This is the European read across from Nike into German rival Adidas, which is up by 2% as we see it now. Back to the top, and this is the broader picture for European equity markets, just like the risk on tone that Matt was talking about for US stocks in the futures market. Well, we see the European session doing pretty well, up by 0.5% if you're long at the market. The thing that's changed since the early hours of the European trading day is the oil price. We were up with 119 being the sort of start of the oil price, the handle, if you like, a little bit earlier on in trade. And now we've really retraced from those earlier highs. That was all driven higher. The oil price was driven higher by reports that suggested that Europe is considering, and our colleague Maria today was talking about this earlier, considering banning imports of Russian oil. Whether we would actually see that agreement reached by the various parts of the European Union and just how quickly it could be reached is another question. And so the market coming back from earlier highs, down by 1.6% right now on Brent crude. The nickel price, we're now seeing two-way action in the nickel price. We're now seeing buyers and sellers, price discovery. We talked to the CEO of the LME a little bit earlier on about all of that difficulty in reopening the nickel market after they had to close it for a few days. Well, we're now down by 9.9%, which is not as far as it could have fallen. Could have been 15% limit down. Once again, it is not, and perhaps this is a sign of normalization on that metals market. And I talked about Adidas already. Matt.
All right, thanks very much for that good market picture there. Let's get now to Christian Müller-Gliessmann. He is Managing Director for Portfolio Strategy and Asset Allocation at Goldman Sachs. And Christian, you know, I thought I would start by asking about asset allocation after the incredible fall that we've seen in treasuries. It's not just treasuries, though. You know, bonds have had an incredibly tough quarter, no matter whether you're looking at sovereigns or corporates. What does this mean to you?
Yeah, listen, I mean, we talked about this before. Like, we know that the standard 60-40 portfolio in the coming cycle is having a much tougher climb. It's likely to deliver lower returns, especially in real terms. And I think the bond market is not going to help you that much with risk management. If anything, it's going to cost you and drive risk. I mean, that's a big difference to the last cycle where growth volatility drove rates volatility. And at the margin, you had this virtuous relationship between equities and bonds. Now rates volatility can drive growth volatility. And that actually becomes a vicious cycle between the two. So I think at the margin, we are kind of avoiding duration. In our asset allocation, we've been underweight both credit and sovereign bonds.
Okay, I mean, that seems like a big statement, Christian, to say that bond markets are not going to help with risk management. Matt's been talking a lot about and we talked in our headlines about the extent to which we've seen this sell-off on bonds, and maybe it is the most in many people's lifetimes. Give us your sort of skies and scope of just how material a change, how material a changed world we are in now when it comes to bond markets.
Yeah, I mean, we have a big regime shift structurally underway, and I think that is something that has been in the making for a few years. There's multiple inflationary drivers like deglobalization, decarbonization, the fight on income inequality. Some of those are moving faster in function of the COVID crisis, the Russia-Ukraine crisis. So they underlying will drive more inflation in the coming years, most likely. But I think to your point, I think bond yields have now moved up a lot. So I'm not saying that bonds cannot buffer if we're facing a recession risk and the market focuses on that topic again. The more bond yields go up, the more there is a bit of a buffer. But you have to also be careful about how much an asset, like a safe asset, buffers you in risk off relative to how much it costs you in risk on. And I think that trade-off is not as good anymore.
Okay, and that's where things have changed. Christian, you talk about deglobalization there, some of that driven by COVID, some of that driven by the war in Ukraine now. How material is that going to be? How much of a change in thinking from corporate leadership are we really going to see? And what kind of impact does that have on inflation? Because it was arguably one of the big drivers of lower inflation rates over decades.
Yeah, I mean, just looking at it simply, I think it sounds like it should be inflationary because at the margin, you know, you have reshoring of supply chains, you have less ability to essentially take the best of the global economy to make your company produce the cheapest, best products, no? You could also argue that there's some offsets because with higher energy costs, transport is getting more expensive. You might actually invest invest into more productivity going forward. So if you have your supply chain completely integrated, you might become more productive. So I think to answer your question, if you go a bit deeper into the deglobalization topic, it becomes very complex. On the face of it, I think in the near term, it seems it has been inflationary, and in particular via the commodities markets, where you kind of see like the segmentation, and it hasn't driven much growth. In the more medium term, I think both the growth and the kind of inflation implications are a bit more difficult.
Well, Christian, of course, inflation front and center for the Federal Reserve, and Jerome Powell made it very clear yesterday they're going to do whatever it takes to combat it. Your colleague at Goldman, Jan Hatzius, now says he sees a 50 basis point hike in both May and in June. Where do you put the likelihood of the Fed being able to execute a soft landing?
Yeah, I mean, you're absolutely right. I think we have a quite unpleasant situation for markets currently, in the sense that normally a Fed tightening cycle is at the early stages quite risk on, and later on you worry about, of course, the kind of financial conditions tightening driving a growth slowdown, because you now have this incredible urgency to tighten. You have a very steep hiking cycle, and that puts the problem much earlier into investors' minds that you might be facing a growth slowdown. And our economists have highlighted they're not only worried about the Fed hiking cycle, they're worried about the fiscal drag that is kicking in the second half at the same time. So you're not just having monetary policy tightening, you also have like fiscal tightening at the same time. And that increases the risk that the growth slowdown becomes more worrying for market, and you get into a bit of a vicious cycle where markets are worrying about recession risk, and by virtue of that, tightening financial conditions, which then increases recession risk. But I think what's important about all of this, you got to ask yourself, is how deep is a recession going to be? Because the private sector is incredibly good health, and real rates are still very negative. So the deleveraging pressure might be limited, and then you might be dealing with a soft recession. And that could be a scenario where you have to be very careful to be too bearish on risky assets for too long.
Okay, so there are recessions and there are recessions. Christian, thank you so much for your time. Christian Müller-Glissman, Managing Director for Portfolio Strategy and Asset Allocation at Goldman Sachs. Thank you very much. Coming up on this program, Orysia Lutsevich joins us, head of the Ukraine Forum in the Russia and Eurasia program at Chatham House. We'll talk about the latest in Ukraine. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Based on evolving intelligence, Russia may be planning a cyber attack against us. It's a patriotic obligation for you to invest as much as you can in making sure, and we will help in any way, that you have built up your technological capacity to deal with cyber attacks.
That was President Biden speaking yesterday about the risk of a Russian cyber attack on the U.S. Joining us now is Orsia Lutsevich, head of the Ukraine Forum and the Russia and Eurasia program at Chatham House. President Biden went on to say that Putin's use of hypersonic weapons shows that he is growing more desperate. What signal do you take from that shift in strategy and how dangerous a desperate Putin is?
Well, absolutely. We see that the first plan of Putin's war in Ukraine, there was supposed to be a swift takeover of the capital and installing of his pro-Russian puppet regime to make Ukraine concede to his demands failed. And he started this desperate tactics of targeting civilians, besieging large Ukrainian cities. I mean, think about just the city of Kharkiv has over 1,000 buildings razed from the ground. And he started using cluster bombs that are forbidden by the Geneva Convention, now supersonic weapons. He's been so-called nuclear rattling, right, threatening and putting on alert strategic nuclear forces. So all of this points to the fact that Putin is not giving up on his demands for Ukraine. He is also willing to escalate in order to subjugate Ukraine. And he's sending very strong messages to the Western allies not to arm Ukraine. He's targeted training grounds right close to the Polish border in Western Ukraine, airports, and he may target supply routes.
Orsia, you know, I'm starting to feel the kind of fear that my parents must have grown up with concerning nuclear weapons. How big of a concern is it for you that at some point we get into a nuclear conflict?
Well, I will tell you that in Ukraine, that night when Russians took control over Chernobyl power station, and then when they recklessly attacked Zaporizhia power station, that was the beginning of very strong fears, because Ukraine as a nation lived through the nuclear disaster. This is not something imaginary threat. This is a real threat that had long-term implications. And now there is a possible speculation on the false flag attack with the chemical weapons. So all of this is viewed as a war of terror on Ukrainian population to sow fear, to perhaps steer some pressure from citizens on political leadership, on Zelensky to concede. But I tell you, from public opinion polling, despite all those horrible fears, Ukraine stands very much resolved to take to do what it makes to preserve Ukraine.
I just mean, we heard from the deputy foreign minister earlier, Russian deputy foreign minister Ryabkov, and he said that Russia's stance on nuclear weapons is responsible. I think everyone's concern is that if the U.S. or other Western allies go in, for example, to close the skies over Ukraine, create a no-fly zone, and Putin sees that as entering the war, that he could then attack back with, you know, nuclear weapons. Is that a concern?
I think we have to be very clear that Putin doesn't need any pretexts to use whatever weapons he chooses, and we've seen it in the course of this campaign. He decides to use supersonic weapons unnecessarily for this particular military campaign, simply to demonstrate the show of force. And the no-fly zone has clearly been taken off the table, and it has been communicated both by NATO Secretary General, by President Biden. Putin knows it. So that's why he is inventing all these false narratives of Ukraine restoring nuclear weapons, or Ukraine having biological and chemical labs that allegedly it may use against its population. This is purely for Russian domestic audience to justify this brutality that is seeping through social media into Russia.
Orsia, it must be difficult to understand, perhaps, given the disruption, the displacement of people in Ukraine, what it is that Ukrainian people think about about specifics here. I was interested in President Zelensky's suggestion there could be a referendum on any terms of any peace agreement. I don't think we've got that far yet. We certainly haven't. But what do you think that would reveal? Where do you think Ukrainian popular opinion would be on what a peace deal would have to look like?
Well, at this point, we have public opinion polls that show that, in a way, Ukrainians are very much clear that they are not willing to compromise any territorial integrity. For example, there is no support for conceding more territory to Russia, not to mention even conceding the annexation of Crimea. This is something that may change over the time depending on the war geography, so to speak. But at this point, Ukrainians are clear that they need a new security treaty. Perhaps if NATO membership is not possible, naked neutrality, so to speak, is neither an option. And there have to be some kind of new treaty to protect Ukraine's territorial integrity. But Ukrainian population at this point is very much determined to continue the fight because they understand the more territory they hold, the better peace deal there will be, if there is a peace deal.
Okay, that's an interesting point to leave it on, Aristia. Thank you very much. Aristia Lutsevich of Chatham House with the latest on Ukraine. Coming up on later programming, Angela Stent, Georgetown Professor of Government and Foreign Service. That's at 8 a.m. in New York, 12 p.m. in London. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Nickel is trading within London Metal Exchange limits today for the first time since reopening. Mark Cudmore and I spoke with the LME CEO, Matthew Chamberlain, ahead of the market opening in London.
The fact that we've gone limit down for the last 4 days does suggest that clearly the price had been inflated by that short squeeze, and it is now logical, with the situations around that squeeze having been resolved, that we would come down to a more normalized level, and obviously the Shanghai price is a good guide there. Today we'll be trading down into the with the limit ability to go down into the 26,000. And I think there is a good chance that we'll discover a price over the next couple of days, possibly even today.
Good morning, Matthew. So you've now had a couple of weeks to consider what's been a pretty hectic situation. What do you think you went wrong? And I know there are many counterparties involved, but I specifically want to pin you down to what do you think the LME did wrong or could have done better?
Yeah, so I think we've clearly been dealing with the immediate challenge, and there's going to be a lot of time for us to reflect on the lessons learned. But I think that there's a few points that I would make. The first is how this squeeze, how this position was allowed to arise, and I certainly think that we need to look more closely again at oversight of the OTC markets, because clearly this is an issue that came from the OTC markets and then impacted the exchange. Then, as has been well publicized, we have had challenges in delivering our price limit. So in order to bring the market back to normality, we needed to make technical changes to our systems to allow to limit the price going down on each day. And that's not something that the LME has ever done before. And we worked very quickly to bring in that price limit technology. And we clearly ran at that hard so that we could get the market reopened. There have been some well-publicized glitches, which I don't think have made a difference to the fact that we just went limit down each day, but clearly have been embarrassing for the LME.
Yeah.
And again, that's what happens when you have to deliver these things at speed to reopen the market.
That was the LME CEO, Matthew Chamberlain, with us before the market open in London. Nickel down nearly 10% so far in today's session, but importantly, that is not limit down. That is not as far as it could have fallen. Let's bring in Will Kennedy, Bloomberg Executive Editor for Energy and Commodities. So is this price discovery we now see on nickel in London then, Will? We haven't fallen 15%, which I think is still the limit down. We're down by just shy of 10.
Looks like it, and as we've been noting in our reporting the last couple of days, that brings it closer to the price in Shanghai, suggesting that that's where the global market
So it looks more normal.
Well, it looks more normal. We seem to be through the worst of this extraordinary market turmoil, and to have found a price where people are both willing to buy and sell.
So the nickel story is fascinating for sure, and I think the LME piece is probably the most interesting of that. I want to get to the oil story, though, Will, because the BN copy on the Mohammed bin Salman, Joe Biden relationship, I thought was just striking today. How can the U.S. convince the Saudis to help them after having ignored them for this entire administration?
Yes, I think the Saudis are going to play hard to get here, and that they will push for a serious quid pro quo if they're going to accede to US demands and other Western countries' demands like Japan and the UK to pump more oil. The problem that Saudi Arabia has is that its alliance, the OPEC Plus coalition that it shares with Russia, has been an enormous success, bringing together the two biggest crude producers of the world into a demand management system. And to some extent, Riyadh is caught between the two. It's going to be quite reluctant to do anything that jeopardizes that relationship for the long term.
Okay, well, thanks very much. Of course, big focus also on EU policy and whether we see a ban on Russian oil. We'll follow the politics in Brussels there. Bloomberg's Will Kennedy joining us with the latest on commodities. More Bloomberg surveillance is ahead, including an exclusive interview with the St. Louis Fed President James Bullard. That conversation at 8:30 a.m. New York time. European equity markets move to the upside, up by 0.5% as yields on US Treasuries continue to rise. This is Bloomberg.
Omicron variant and the latest wave have an impact on not only consumer trends, but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm still a big believer that the physical global economy continues to motor along.
It really does come down to the consumer. And, real consumption is still very strong.
We are absolutely looking at possibilities of oil prices over $150 this summer.
Where is inflation going to settle? How far is the Fed going to raise rates? And what's the outlook for growth?
There's kind of another inflationary shock that might require more hikes as well from those central banks. This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Lisa Abramowitz and Katie Lyons, I'm Jonathan Ferro with futures up 1/3 on the S&P. Bramo, once again, the action is in the bond market.
And the stock market is not even noticing. The bond market absolutely selling off to the highest pace that we've seen, frankly, in data going back to 1973. If you look at it on a quarterly basis, how high can yields go before stocks start to notice?
It's the March meeting on repeat. Do you remember the run up into that? 50 basis points or 25, 50 or 25. We're pricing in 50 for May.
The tone has shifted, though, and I would argue that there's probably more momentum behind the 50 basis point hike than before, because frankly, yesterday, Jay Powell came out and said at that NABE conference, listen, there is nothing holding us back from a 50 basis point rate hike. And frankly, the threshold is now to see more information showing that inflation is slowing than to simply see some hints of it, or to basically the threshold is to see some deflationary or disinflationary trend to stop them from that 50 basis point hike.
Jan Hatzius over at Goldman thinks they won't just do it once, they'll do it twice. Katie Lyons, a 50 basis point hike at both the May and June meetings. The new call from Goldman Sachs.
Yeah, I think it's noteworthy, though, John, that their terminal rate of 3 to 3.25%, that estimate hasn't changed. But so they do think it's going to be this ramped up front loading. And I was talking to Christian Muller-Gleesman of Goldman about that earlier today, about this idea of whether or not the Fed is going to be able to execute a soft landing in that case if it moves that aggressively with 100 basis points in hikes over just 2 meetings.
To pick up that point, and I think it's an important one, Lisa, do you think that brings the equity market some form of comfort, that the Fed might be going more quickly, but ultimately the journey ends in the same place?
Does it? What is the same place? I'm sorry, not to be, bearish.
No, sure, but if you look at the market pricing, it's adjusting for a faster Fed, but not a higher peak in the Federal Reserve's funds rate.
Right, and avoiding a recession too, because right now we are not seeing a recession priced into credit. We are not seeing a recession priced into many stocks. My point is, yes, they're seeing a front loading, but they're also seeing it not necessarily disrupting the trajectory so materially to derail the equity story. And I'm wondering how this is the case, especially as even Chair Powell came out yesterday and highlighted this sort of harrowing aspect, the harrowing path to some sort of soft landing. market.
You don't sound bearish at all on any of that. Futures.
I'm not making a call. I'm
Positive,
just saying,
of course not.
You know,
Up a
just my
quarter
neurotic view
of
of the world.
1% on the S&P. On the Nasdaq, up around about a quarter too. We're doing okay in the equity market. These moves in the bond market though, 234 on 10s. Yields higher by 5 basis points. Crude lower to 109.63, down a little more than 2%. Euro dollar at 109. Big move in dollar yen. Dollar yen through 120. We can talk about that a little bit later. 120.86. That currency pair, Lisa, up by more than 1%.
And if you take a look at the bond market and the divergence between Europe and the U.S., it's the widest going back to 2019. If you take a look at 2-year U.S. yields versus 2-year German yields. Today at 8:30 a.m., St. Louis Fed President Jim Bullard will be joining Bloomberg Surveillance. I am very curious to hear how he categorizes what we heard from Fed Chair Jay Powell yesterday. Perhaps we're not seeing a reaction to equity markets. The bond market, John, as you were saying, very much has moved. And right now, traders are pricing in 8 rate hikes through February of next year. That brings the the Fed funds rate to 2.4% at that time. There are other Fed speakers throughout the day, including New York Fed President John Williams, San Francisco Fed President Mary Daly, and Cleveland Fed President Loretta Mester. Yes, we're going to be talking about the 50 basis point rate hiking cycle in May. How much conviction is there behind this? But also the yield curve. And frankly, Jay Powell dismissed it yesterday as not being necessarily something that portends recession. Yet we are seeing that 210 spread, that key spread, narrow to the least going back to 2019. And if you take a look at the gap between 5-year and 30-year Treasury yields, it is the lowest going back to 2007, a year that would not be a particularly happy one to compare this one to, considering what happened the following year. Today also is day one of the Bloomberg Equality Summit, which will include the CEOs of Macy's, Visa, New York Stock Exchange, and New York Life Investment Management. I'm curious to hear how they address the current situation in Russia. How do you deal with a fast-moving ethical backdrop? What does it mean to have ethics roped into investment theses at a time when commodity sectors left for dead or left for ethical dead are now absolutely booming? John, it is a conundrum to get performance for a lot of the same foundations and, frankly, retirement accounts at a time when the concept of ethics is fastly changing.
Lisa, thank you. Looking forward to your coverage of that event through the day right here on Bloomberg. Right now, team coverage with Bloomberg's Joe Matthew in Washington and Maria Tadeo in Brussels. Maria, the Ukrainian president addressing the Italian parliament at the moment. That starts any minute. What's the ask today?
Well, Jonathan, you see that this tour continues in which the Ukrainian president, of course, is trying to quickly address European leaders before President Biden gets here on Thursday. Of course, he wants to see weapons being delivered to Ukraine. When I speak to a lot of Ukrainian sources, what they argue is that the West really needs to come to this understanding that Ukraine is not going to surrender and this fight will continue. And we saw it yesterday when the Ukrainian government refused to surrender the city of Mariupol, which for many has now been 80% destroyed. Of course, the other big issue will be sanctions to increase the pressure on the Russian. And today we see that the Russian Federation is still able to pay coupons on their sovereign debt. And we still see that they continue to sell oil and gas to the European Union. And that conversation will dominate here on Thursday, Friday, Jonathan, when it comes in particular to those imports of oil and gas. Now, are we going to get anything that looks like a full ban by the end of the week? I have sources that tell me that is not going to happen. There is no unanimity around this. We need 27 countries to agree. Having said that, the debate is actively back on the table.
Maria, there are reports that there's the potential for chemical or biological weapons used by Vladimir Putin on Ukraine. What are the red lines among the European leaders as far as what will provoke a greater action and really provoke more discussion of actions beyond sanctions?
Well, it's those two. It really is chemical, biological weapons used on the civilian population of Ukraine. Unfortunately, we have seen repeatedly that Russia does target sites where there's civilians. It's not military sites. When you see a school that gets bombed or you see a hospital, a theater where people are hiding from Russian bombs, that gets completely obliterated by very heavy artillery. But for Europeans, what they say, that would be a real red line. Essentially, if that is the case, then you'd see a repeat of what the Syrian forces did in the Syrian war. And for many Europeans, what they'll tell me is, in a flight that's 2 hours away from right here where I'm sitting, you can't have an Aleppo 2.0. You can't cross that barrier. That would be unacceptable. And of course, that would trigger perhaps what is seen as now the nuclear option, lack of a better word, but that would be the energy, of course, sector.
All right, Joe. Well, obviously, when we're talking about weapons at Russia's disposal, it's not just chemical, it's not just nuclear. You also have cyber attacks potentially, and that is something that President Biden warned about yesterday. Attacks directed not at Ukrainian cyber infrastructure or Ukrainian companies, here in the U.S., potentially those cyber attacks on the horizon. What would be the administration's response to that if it comes here to U.S. shores?
It's a great question, and they really have not answered it. We don't know exactly how that would be interpreted by the White House if, in fact, there was a cyber attack on not Ukraine but the U.S. This is why the federal government has been briefing dozens of companies, about 100 according to our reporting at Bloomberg, to get them to harden their defenses for what they believe is a potential attack here. Evolving intelligence is the phrase that was used last evening. The president spoke to the Business Roundtable about this briefly. It's interesting when you look at this, Kaylee, some of these companies have really quite primitive defenses. We're talking about double authentication. We're talking about encrypting sensitive data, and some of these companies have not done that. So the White House is trying to take a first step to have these companies harden their defenses without suggesting that this would be interpreted as an act of war, but that remains unclear this morning.
Joe Matthew, thank you, sir, from Bloomberg, alongside Maria Tadeo as well. These moves in this bond market, just want to stay on top of them for you. Yields higher on 10s by 5 basis points to 234. On 2s right now up 6 or 7 to 218. Elisa, just massive moves.
Yeah, just to put this into perspective, I was looking at the lows this cycle for the 10-year yield, and going back to late 2020, it was 0.5%. So we have quintupled over the period in terms of where we are, nearly quintupled. Just to give you a sense of how quick this move has been, and the amazing ability, frankly, for credit and credit spreads to absorb this has shocked me, right? We are not pricing in recession yet, and yet can we avoid some sort of economic slowdown or even downturn if the Fed is that trained on getting rid of inflation?
So just to go through this, Kaylee, the 3-year yield, the 5-year yield, the 7-year yield, all above the 10-year yield. And the move on 3s yesterday, one of the biggest moves we've seen going back to 2009.
Yeah, more than a decade, John. You have all of these durations starting to see these curves inverting. What hasn't inverted yet, of course, is 2s, 10s. You still have the 2-year yield. That's about, call it 16 basis points south of that of the 10-year. But I thought what was interesting is Powell's commentary when asked about this yesterday at NABE. He's not so much worried about the vanilla curve. He pointed to the 18-month curve, which is steepening, John.
So it won't constrain the Fed, according to Chairman Powell. Do you think it will shape risk appetite? Because so far, it doesn't seem to be doing that at all.
Yeah, we haven't gotten to that point yet. I wonder if curve inversion when it comes to the 2s, 10s would be a different story for this equity market. But as you're seeing parts of the curve inverting, the equity market's by and large been able to look through that for reasons kind of unknown, John.
Has anyone pushed back against this, Lisa? Just going through the Fed speak. Bostic, not wedded to moving only 25. Powell, if we conclude we need to move more quickly, quote, we will do so. Very open to half-point moves. That was Barkin. Waller, the data is basically screaming at us to go 50. That was Governor Waller to CNBC last week. They're all lining up to say, if we need to, we will. And it looks like they need to and they will.
Which is a lot more conviction than we had going into this previous meeting in terms of a 50 basis point rate hike. What I'm curious about is the balance sheet. Do they start to target a more rapid wind down of the balance sheet because they are concerned about that yield curve? Or do they hinge their views on what we heard from Fed Chair Jay Powell yesterday, which was typically that inversion signals a downturn because the Fed is hiking rates at the end of the cycle. And so it's just a correlation but not causation.
Would you suggest this time around it won't be like watching paint dry? Not that last time around it was like watching paint dry either.
I'm going to have a view.
Take the view.
I don't think it's going to be like watching paint dry.
There we go.
Isn't that bold?
That's bold of you. Up 0.25% on the S&P from New York City this morning. Good morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Russia is refocusing its military campaign in Ukraine on the east in what may become a narrower set of goals for Vladimir Putin. One of the primary targets, the port city of Mariupol. The bombardment of the city has continued as a Russian deadline for surrender expired. The intensity of the attacks is striking given the slowing Russian war effort elsewhere. President Joe Biden is warning the private sector, improve your defenses against cyber attacks immediately. The president says the Kremlin may be plotting cyber attacks to retaliate for sanctions imposed for the invasion of Ukraine. The White House provided few details about the nature of the threat. And the Federal Reserve Chair Jerome Powell is now using a more aggressive tone towards curbing inflation than he did just a few days ago. Powell said the Fed is prepared to raise interest rates by a half percentage point at its next meeting if needed. Last week, policymakers increased the benchmark lending rate by a quarter point. And in Canada, Prime Minister Justin Trudeau reportedly is nearing a deal that would keep his Liberal Party in power until 2025, according to CBC. Trudeau's government is discussing an agreement with the left-leaning New Democratic Party. If there is a deal, it would reshape Canada's political landscape. And Alibaba has ramped up its share buyback to $25 billion. China's e-commerce giant is reacting to staunch a $470 billion loss of value during Beijing's internet crackdown. The government has pledged to support the economy and finish the clampdown on the tech sector as soon as possible. That triggered a historic rally in Chinese stocks. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
York City.
Here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Bloomberg has the Fed covered all week. Today, an exclusive interview with St. Louis Fed President Jim Bullard.
There's just risk out there, and markets are going to have to price that risk.
Tomorrow, an exclusive interview with San Francisco Fed President Mary Daly.
Balance sheet policy is just another part of our policy toolkit.
The most in-depth coverage and analysis of the Fed.
Which meeting matters? Every meeting matters.
Continuing coverage this week on Bloomberg Television and Radio.
Based on evolving intelligence, Russia may be planning a cyber attack against us. It's a patriotic obligation to invest as much as you can in making sure, and we will help in any way, that you have built up your technological capacity to deal with cyber attacks.
A warning from the President of the United States. From New York City this morning, good morning. Futures higher by 1/3% on the S&P. On the NASDAQ, up by around about 1/4. In the bond market, a lot to talk about. Yields higher by 6 basis points on 10s to 234.60. Before we get there, some headlines, Katie Lines, coming out of the Kremlin.
Yeah, the spokesman for the Kremlin, Dmitry Peskov, is speaking on a conference call, and he says that Ukraine talks are slower and less substantive than hoped, kind of reiterating the messaging we have been getting from Russia in recent days about the slow progress of those negotiations, John. It just goes to show you and show this market that there's not necessarily going to be a quick resolution to this conflict, especially when you have President Zelensky of Ukraine saying that any agreement that is reached, and the operative word there being if an agreement actually is reached, will have to also face a referendum and be voted on by the Ukrainian people. This is going to be a long, drawn-out process, John.
At least the Kremlin not even talking up talks anymore.
And the market doesn't care. And that's what I find so interesting, that basically we have seen this before, and right now people are dismissing all headlines and frankly acting as though you can look at this conflict as a set of parameter of risk rather than something that could percolate into something larger or longer.
Well, the market care about this from Goldman overnight. We now forecast 50 basis point hikes at both the May and June meetings. Joining us now is George Concalves, the head of US macro strategy at MUFG. George, I want to start here. Did we underreact last week or overreact yesterday?
I think the market's now starting to play a huge catch up to the fact that, that there's a really big moment of truth in the bond market. Are these, longer term structural factors that have been guiding bond investors for decades now, are they really, about to go unhinged? Is this new world concern around constant inflation, supply disruptions, and just a new inflation regime upon us that the Fed and central banks the world over have to really preserve the sanctity of their inflation credibility. Otherwise, bond investors are going to look the other way, and that's really a big concern for the bond market right now.
George, you've got a radical call for only 3 or 4 rate hikes this year, which is radical considering the fact that we're pricing in 7 to 8 rate hikes. If you take a look at Fed funds futures, why do you think it's only going to be 3 or 4?
I think we lost George there. I don't think George can hear us. Can you hear us, George?
I think
we're going to re-establish that, George, in just a moment. George Concalves there of MUFG. Lisa, looking at the spread between, let's say, 5s 30s, lowest since 2007, 2s 10s, lowest since March 2020. The thing's pretty clear over the last few weeks. This curve is flatter and pockets of it inverting. We've been on top of that over the last several days.
Well, if you take a look at George's assertion that basically the bond market has to have faith that the Fed can control inflation and get longer-term inflation down to a more normal pace, then why not buy the long bond if it's above 2%, right? I mean, it sort of is a self-fulfilling prophecy unless you think the Fed is unable to bring down inflation or unwilling to do so. And so how much are people just betting on that and in the near term expecting a lot of rate hikes needed in order to get back to that kind of area?
George is back with us now. I understand he can hear us. George Concalves of MUFG. We've re-established that connection. George, let's pick up on some of the issues we're talking about through this morning and have been talking about over the last several weeks. And let's start with what we're pricing in this bond market. What are we pricing now?
We're pricing now, and by the way, thanks for putting me back online. I thought you guys cut me off because I have an unconventional view on the bond market. But in all seriousness, I mean, what we're pricing in now is a market that is really pricing a high price on liquidity. We have a complete curve think I lost you guys again.
George, if we've lost you, we're going to come back to you soon. And not because you have an unconventional view on the bond market, just because there is a technical situation here. George Goncalves there of the MUFG. What are we pricing at the moment, Lisa? I have to say, if we're pricing in an inverted yield curve and we do that quickly before we get another interest rate hike, if the whole curve inverts by the time we get to May, we're not pricing in a soft landing, are we?
Well, that's what people are thinking. The Fed pushes back against that and says that, frankly, we've seen such an unconventional bond market over the past couple of years that perhaps you can't take the same signals from it. And yet, it does seem like it's getting more difficult to get to a soft landing. I mean, honestly, we've heard that from a number of strategists coming out and saying by the day, the chances of a soft landing are deteriorating.
Why do you think this market shook some of this off last Wednesday? It's the mystery for me, for you, for Kaylee. Have you drawn any conclusions on that over the last few days, Lisa? What happened last week where Chairman Powell essentially repeated what he said yesterday?
I think a lot of people were wondering, if you are so hawkish, why not go 50 basis points then? Why not take a more dramatic move with the balance sheet then? Why not give more guidance? Why wait? What are you waiting for? And what we heard from him yesterday is, frankly, they're not waiting for anything, and that perhaps the Ukraine war was the main factor in why they didn't go 50 basis points, but it's not going to stop them going forward, and they're assessing the risks. They're on both sides with both the slowdown but also higher input costs. And frankly, he talked about how inflation is not just going to come back down. He is no longer in team transitory, and I think that that's been a big shift.
Governor Wallace said as much last week in that interview with CNBC, talked at the prospect of 50 and basically said the reason we didn't go is not because of the data. The reason we didn't go 50 is because of the geopolitics. Given what's happening with financial conditions, though, Lisa, yesterday, Wednesday, Thursday, Friday, the equity market was up almost 5%. You and I were talking about how Chairman Powell might respond to that and whether he'd be surprised by the move we'd seen. I think he probably was surprised based on what he communicated on Wednesday. On top of that, the balance sheet discussion has barely featured in anything at the moment. We need to talk about size. And is that going to be passive this time around, or do they actually understand the effect it will have on financial conditions and consider it some form of tightening?
And if the market isn't getting the message, given that they have not exactly been shy about their views, then what will it take? And this is where the soft landing discussion becomes somewhat difficult, because if they need to crimp demand in order to effectuate lower inflation, then they have to do more, which means that they have to dampen demand, which means they have to engage with some sort of slowdown. They have to manufacture a slowdown. And I think that that's not being priced into equities, because either they think that they're still as transitory, or they think it's just going to make it all better and it's not going to be that big of a deal.
Staying on top of two issues this morning, not just the Federal Reserve and the big action, the price action we're seeing in the bond market, but also President Zelensky of Ukraine addressing the Italian parliament. And Kenny Lyons saying this just moments ago, that the Pope playing a mediating role would be appreciated.
Yeah, looking for help anywhere he can, John, I guess, including the Vatican. I mean, this is really just the latest in a series of pleas that President Zelensky has made to countries, to world leaders across the board. He was in the U.S. just last week. He is now speaking in Italy, John. We know what he wants. He wants aid. He wants weapons. In theory, he would like a no-fly zone, though it seems that that is still a non-starter as this war continues to rage, and the Kremlin says that talks are making very slow progress.
We'll stay on top of those headlines for you from New York City this morning. Good morning. Lucky to have Katie Lyons in the seat. TK still away. He'll be back in a couple of days. From New York, this is Bloomberg.
you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Live from New York City for our audience worldwide on TV and radio, here's the price action in this equity market. On the S&P, up 1/3%. On the Nasdaq 100, up 1/4%. In the equity market, all is calm. In the bond market, I'd say anything but. Let's look at this. 2s, 5s, and 10s. Your 2-year yield, just short of your 10-year yield. We'll get into that in a moment. Your 5-year yield is above your 10-year yield. This pocket of inversion, 237.40 on 5s. 234.60 on 10s, and the compression we're starting to see right the way through the curve. 5s, 30s, the lowest since 2007. 2s, 10s look like this. 17 basis points between them now. The tightest between these two that we've seen, Lisa, going all the way back to March 2020.
It seems like the bond market's pricing in near term we're going to avoid a recession, but over the next 3 years, over the next 4 years, it seems unavoidable. And I think that that's what you're seeing increasingly recognized by bonds, perhaps not yet by stocks.
One stock to watch in the pre-market, they keep delivering. Katie Lyons, Nike.
Yeah.
Nike bouncing back by almost 6 percentage points, 137.90. Jeffrey saying third quarter underscoring strength of Nike's brand as demand continues to exceed supply. And that last line came from the Nike CFO as well. Demand continues to significantly exceed inventory. That's the situation still.
Yeah, still working through some of those supply side challenges, though on the production end, it has gotten a bit better for Nike because you've started to see some COVID restrictions lifting in the regions in which they produce. But what also is notable is, in addition to working through some of those supply chain issues, weakness in China is starting to improve. Yes, you still had China sales down, but less than expected, just part of the beats in the revenues for regions across the board for Nike.
That's a story for Nike in the pre-market up nicely. Let's talk about this commodity market. Crude has been all over the place, and nickel's been its own story. Let's get to Francisco Blanch, the head of global commodities and derivatives research at BofA Global Research. And Francisco, let me throw this one out there. The LME, how much credibility has the LME lost in the last few weeks?
Hey, John. Well, it's been a messy process, that's for sure. But one of the advantages of having multiple exchanges around the world is that we've continued to see a live price for nickel in Shanghai. So even though we've had some disruptions in trading for several days, I think at least there's been a reference out there that people could track, and that's been a positive, I think, compared to prior crisis.
Francisco, how much more do we have to see of these clearinghouses getting disrupted, or even the consequence of them increasing their margin requirements in order to avoid some sort of disruption like that, leading to lower liquidity?
Well, as you know, since the financial crisis, we've been concentrating a lot of the risk on exchanges, and obviously that's I think partly creating some of the problems. But also remember, as volatility in commodity markets goes up to unprecedented levels, it really is hard to avoid bringing up those margin calls, or bringing up those margins in the commodities that people trade, because the risk is just simply a lot higher. And we've seen that with nickel, we've seen that with other commodity markets. And I even think that some of the weakness we saw in oil in the last week and a half or so was related to the liquidation of long positions linked to increased margin calls. And of course, as you probably know, open interest has actually fallen in oil despite the incredible risks that we are running here with the war in the Ukraine still unfolding and still at a crucial point, I would say.
Amrita Sen of Energy Aspects actually pointed to that phenomenon as a reason why oil prices are so low, not so high. And she actually thinks that Brent could get up to 150. I think you agree with her that by June we could see Brent get up to 150, but then quickly fall back down. Do you still believe that it will quickly fall back down based on the fact that a lot of people expect a prolonged conflict and prolonged consequences in the commodity markets?
Well, our scenario since October of last year was a spike to $120 a barrel by the summer. And we had that view based on a post-COVID demand recovery, on limits to how much OPEC can produce, on limits to how much shale is likely to respond, and of course inventories, which are still very low. I think what the Ukraine crisis has done is probably lifted the entire expectation by at least $25 to $30 a barrel. So we actually do have a $150 target for the summer in our baseline scenario, and an average of $110 for the year. It could still get worse, right? I mean, I don't want to sugarcoat this. It's a very bad situation, and Europe could still opt to restrict Russian oil purchases, in which case we would see meaningfully higher prices. That's what we call our ugly scenario, is where Russian supplies not only get disrupted by 1 million or 1.5 million barrels a day, but up to 4 million barrels a day in a market, of course, of 100 million barrels, where Russia actually supplies about 8 to the global to that global market. So things are not great and could still get a lot worse. And actually, if you look at the petroleum product markets, we've seen diesel prices already surpassing the high points that we saw back in 2008. So it's not just crude oil itself, it's also some of the petroleum products. And again, diesel is the basis of the economy, is the basis of everything we do, from harvesting to industry, and diesel is connected to jet fuel, which is obviously flying, but also trucking. So really the backbone of the economy is being very impacted by these exceptionally high fuel prices. It's the new fangs, is fuel, agriculture, aerospace. It's also nuclear and renewables, and of course gold and critical metals. So it's all of that that's kind of come back into the fore with the crisis. So,
Francisco, you mentioned there an ugly scenario. In the ugly scenario, what does that equate to in terms of a dollar figure on a barrel of crude? How is that different from your base case of 150 by summer?
Our ugly scenario is $200 a barrel plus, and the way we get there again is pretty simple, right? I mean, if you think about every million barrels a day of disruptions from Russia equates to $20 to $25 a barrel on the price. So if we get to go from 1 million plus to 4 million or so, we have to add $60 to $70 a barrel to our baseline spike scenario. And as I said, I mean, I think that's been what's been so difficult to impose restrictions on Russian exports, because at the end of the day, when you sanction a commodity of a very large producer, you're ultimately going to end up paying a higher price as a large importer. And of course, the European Union is one of the world's largest importers, together with China. Mm-hmm. So restricting the supplies of energy from your largest supplier, which again Russia supplies a third of Europe's oil and 40% of Europe's gas, essentially would just significantly elevate energy prices, which are already at record levels. So that's why I think there's been a lot of political debate there.
Well, Francisco, let's talk about other sources of supply, though. What assumptions are you making about potentially more capacity coming online from OPEC Plus or from the shale patch?
Well, from OPEC Plus, obviously, I think the big potential supply additions could come from Saudi Arabia or from the Emirates, United Arab Emirates, We've also seen some progress being made on the Iran nuclear deal, which could also provide some relief. If you put together all of those, there could be up to, let's say, up to 3 million barrels a day of incremental supply. I'm talking about Iran, Saudi Arabia, and Emirates trying to max out production. The issue is, of course, with the very low inventory levels that we have, if we max out production, then there's really no room for error. We are kind of keeping our fingers crossed that no missiles from Yemen end up impacting Saudi export facilities, or that the situation in Libya doesn't worsen, or that, God forbid, we see another string of supply disruptions elsewhere around the world. So that's where the challenge is. Remember, energy security has taken the really pretty much the headlines here, and I think when you look at ESG versus energy security, we've seen a much bigger focus on energy security, because security is like oxygen, right? Energy security is oxygen to the economy in the same way that security and national security is oxygen to all of us, because you don't think about it much, but once you don't have it or you start to lose it, that's the only thing you can think about. And that's really the I think at the heart of all the debates we're seeing in the political sphere. And I think all the warnings that have come from people like me, the analysts, saying, well, there's pros and cons. If you end up pushing too hard on the restriction side, you could also end up with a very bad economic outcome.
Well, Francisco, let me pick up on that. Just finally, because the policy change we could see from this energy transition, there was almost a disregard for fossil fuels over the last few years, particularly at the beginning of this administration. Do you think it will change things on the policy front over the next several years? Not just this year.
Look, I've been making the case that the U.S. Would go from energy independence to energy dominance. And energy independence, we made the case 10 years ago when shale started to emerge as a new and feasible technology. We saw an enormous amount of supply growth, and we thought the U.S. was going to become independent. Now we think it's going to become dominant. And regardless of policy, remember, markets in the U.S. are very, very powerful forces. And with this kind of prices, we're going to see a lot more liquid natural gas exports out of the U.S. Even Secretary Kerry, former Secretary Kerry, has actually agreed that natural gas is now critical to the energy transition. So we're going to see more of that. We're going to see more petroleum product exports. We're going to see more chemicals exports, more fertilizer exports. Just the U.S. is going to really grow dramatically its energy production base as the rest of the world is facing the shortages. Remember, the U.S. natural gas price is still $5 an MMBTU, under $5 an MMBTU. So that's about $30 a barrel of oil equivalent. So America has not only the cheapest energy on the planet, but also the safest, Jonathan. And I think these are two very good reasons to up investments in the energy space in the U.S. And I think we'll see that. Even I think President Biden mentioned himself that there's a lot of leases out there that can still be drilled, and I think they will. I think we'll see a turn as particularly as the situation between Russia and the Ukraine becomes more entrenched, and presumably U.S. sanctions, UK sanctions, potentially European sanctions could be there for years, potentially degrading as well the profile of commodity production for Russia, which as you all know is the world's #1 commodity producer on many fronts.
In a big way. We've learned that the hard way this time around. Francisco, got to leave it there, sir. Francisco Blanch there of Bank of America. Lisa, some massive numbers. 150. They're not backing away from that.
Not only, they're actually doubling down and saying that that's the base case versus $200 a barrel if things worsen.
Futures picking up here, up 0.4% from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. Ukraine's President Volodymyr Zelensky says he's ready to discuss a deal with Russia. He told Ukrainian TV he would discuss a commitment from Ukraine not to seek NATO membership. In return, Zelensky wants a ceasefire, the withdrawal of Russian troops, and a guarantee of Ukraine's security. Investigators are trying to figure out why a China Eastern Airlines Boeing 737-800 suddenly fell from the sky. The crash in the South southwestern part of the country is believed to have killed all 132 people on board. Air crash experts are baffled by the plane's nosedive from 29,000 feet. Meanwhile, China Eastern grounded its fleet of those planes. Nickel is once again trading within the London Exchange's daily limits for the first time since reopening last week. It's a sign that the market is starting to stabilize after an unprecedented squeeze sent prices soaring.
There have been some well-publicized glitches, which I don't think have made a difference to the fact that we just went limit down each day, but clearly have been embarrassing for the LME. And again, that's what happens when you have to deliver these things at speed to reopen the market.
The LME was criticized after it allowed nickel prices to soar more than $100,000 a ton. Global News, 24 hours a day. I'm Ritika Gupta. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
likely will see an uptick in cases as we've seen in the European countries, particularly the UK. Hopefully we won't see a surge. I don't think we will. The easiest way to prevent that is to continue to get people vaccinated, and for those who have been vaccinated, to continue to get them boosted.
Dr. Fauci, the director of the National Institute of Allergy and Infectious Diseases, on ABC over the weekend from New York. Good morning. Futures positive 0.4% on the S&P, on the Nasdaq up 51, up 1/3%. Staying on top of the bond market for you. Yields higher by 5 basis points to 234.24 on the pandemic. Joining us now is Dr. Amish Adalja, senior scholar at the Johns Hopkins Center for Health Security. Might sound like the former president here, Doctor, so forgive me for going there. I remember at one point you said, well, cases are high in America because we're testing loads. I just wonder at this point, should we still be testing as much as we are?
I do think we need to be testing a lot because now we have antivirals that are linked to being diagnosed within 5 days of symptom onset. So we still need to have robust testing because if we're going to use those tools to be able to tame COVID-19, to make it more like other respiratory viruses, we have to diagnose people. And I don't know what the exact number of tests needs to be done to be sufficient, but I think we want to have robust testing so people know what they're sick with and can get linked to treatment.
Dr. Adalja, we're watching the wave over in Europe intensify, particularly with Germany with record cases. And as it sweeps across the continent, people are wondering when the latest variant, BA2, of Omicron is going to hit the U.S. What's that going to look like in terms of cases, in terms of hospitalizations?
So it's already hit the United States. Maybe about 1 in 4 cases is already BA2. So this is something that's already spreading and likely will become dominant in the United States in terms of the type of COVID-19 that's circulating. Cases are definitely going to go up. How high they go up still remains to be seen because we've got a lot of immunity from the Omicron wave, a lot of immunity from vaccination that may limit its ability to spread. I don't think, though, it's going to translate into hospitalizations going to a crisis level because I think we're increasingly decoupling cases from hospitalizations. And I think we've got to keep emphasizing the fact that, yes, there's always going to be cases. They're going to go up and down. There's going to be hot spots. There's going to be new variants. But the goal is to shift those cases to the outpatient world, cases that don't require even a call to the doctor because they're so mild or because they get quickly linked through test and treat to antiviral treatment or to monoclonal antibodies. All of that's going to be what's key as we move through this wave.
A lot of people in the market, Amish, have moved on. They think the pandemic is over and they're waiting for revenge travel or just the resurgence of people actually going out and doing things. People aren't wearing masks. It feels more normal. Are we going to revert back to what we saw over the past 2 years, or is this what we're going to experience because people, frankly, will treat this like the flu now more broadly, as it seems to have that kind of consequence?
For the vast majority of people, I think they will probably treat it like the flu. They'll treat it like another respiratory virus that they're protected against, and maybe will get infected and have a little bit of a disruption for a couple of days, but not something that occupies the same amount of time in their mind or their risk calculation as it once did because of all of the tools. They're going to be immunocompromised people, though, that are still going to have to be much more vigilant, especially when they're in high-risk situations. They're going to probably continue to wear masks and be mindful of their contacts. But for the vast majority of people, because of all that we've been through, all the tools, I think it will be something that's more of a mild illness. And where when everybody gets that, it's a little bit unclear, but I think that's definitely the trajectory. I think airplane ticket sales are surpassing 2019 levels now. So people are sort of going back to their normal life as best they can.
So Dr. Adalja, can we do without a fourth shot or a second booster?
I think it all depends on who you are. If you're a healthy person, I think that a fourth vaccine is really going to have diminishing returns, if any. High-risk people, people that are older, people that have other medical conditions, and especially those who are immunocompromised, a fourth dose may make sense. But I think that we shouldn't be in the process of this kind of process of thinking that boosting is the way to get out of this pandemic. It's still first and second doses that matter the most, and then the immunocompromised individuals, those are the people that are going to need extra protection with boosters, with certain monoclonal antibodies that can be used prophylactically. But I think we do need different vaccines and second-generation vaccines if we're going to start to think about cases versus severity of infection, because when you think about the vaccine, the major function of it is to prevent severe infection. So that's why I think boosters should be targeted to high-risk individuals, not universal, because it really makes sense only to protect people that are at high risk for hospitalization. And that's where I think fourth doses should be considered.
Doctor, in the commercial break, back in the day, Lisa would turn around to me and say, when is this over? And I would turn around to her and say, well, who are you waiting for to tell you that it's over? Does someone come on TV and say it's done? And I just wonder, from your perspective, how do you define the end of this? How do you measure it?
It's going to be different for each person because it's how each person has acclimatized to the risk of COVID-19. But to me, I think it's when you don't see hospitals worrying about capacity. And largely in the United States, that's already happened. I have to go work at right after this show, and it's not going to be something where I'm seeing a lot of COVID patients. So for me, in that sense, it is over in the acute phase of it. Yes, there's going to be cases, but it's not going to be anything like the caliber we saw in the early days of the pandemic or even during the Delta and Omicron waves.
Dr. Amish Adalja of Johns Hopkins. Thank you, sir. Thank you very much. Lisa, that answers part of the question for you. Of course, sometimes you're asking about the end of the show and not the pandemic. But on this occasion, on the pandemic.
I love that your question to him is, are you going to be that person to come on here and ring the bell and say it's over?
I do wonder what people are waiting for. Does someone go on TV? Does the president? I mean, he did that last year, didn't he? And didn't quite work out.
I think that a lot of people are treating it like it's over. You're seeing masks come off. And the reason why I find it so interesting is because we are hearing about the resurgence of cases over in Europe. And you raised the question to start with, does it matter? I mean, should we even be tracking the cases the way that we are? Should we be tracking cases of the cold the same kinds of way and reporting them? Would it be that sensational to see the rise and fall of various illness? Because if we're not seeing the hospitalizations and deaths, it doesn't have the same implication for socialization and, frankly, for the economy.
Well, as the doctor pointed out, Katie, the ultimate measurement of whether this is over or not is the healthcare system. Hospitals, are they overwhelmed? And in the doctor's opinion right now, in this country, no.
And hopefully they stay that way and BA2 doesn't start to cause problems on that front, given, yes, most Americans are vaccinated, the majority, but not all. And booster shots, that rate is even less. So that's something to consider. But I think what was telling to me, and for the market specifically, is that COVID-19 wasn't even really mentioned as a risk by the Fed last week. After 2 years of consistency, that being an uncertainty that Federal Reserve officials have to consider. The only time it was mentioned was in the context of the inflationary forces that the demand recovery offset.
But it was a big problem for them in September. Something didn't happen that they wanted to happen. Yeah. Do you remember in September, Lisa, we'd always talk about September. It was back to school. It may help people get back to work. We'd start to see a supply side response in a bigger way towards the end of the year. That's what they were betting on. That's what they were betting on happening, and ultimately they were hoping that inflation after that would trend lower, and that hasn't happened.
Well, we had the Omicron variant, and what we heard from Fed Chair Jay Powell is that as soon as that crisis, the pandemic, was over, this new crisis has led to supply chain disruptions that do not lead them to expect supply chain disruptions to fix themselves, right? That was a shift in tone that we heard from him yesterday. He basically was saying we have to see real progress rather than just assume that things will roll over and we'll get back to some sort of base effect. The base effect isn't in their favor anymore because this new crisis is even more disruptive when it comes to supply chains.
I know it's only one company, one story, but Nike, I think, speaks for a lot of what's happening in corporate America and around the world. For the CFO to say demand, quote, continues to significantly exceed inventory. That's been the story of the last couple of years, hasn't it, Lisa?
Yeah, and frankly, it's just a bit about production and getting it to the stores. But I mean, honestly, what else have people been able to do but go out and shop?
Futures, another lift, up a third of 1% on the S&P. From New York this morning, good morning. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm still a big believer that the physical global economy continues to motor along.
It really does come down to the consumer. And, real consumption is still very strong.
We are absolutely looking at possibilities of oil prices over $150 this summer.
Where is inflation going to settle? How far is the Fed going to raise rates? And what's the outlook for growth?
There's kind of another inflationary shock that might require more hikes as well from those central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Some big calls for a big move in the month of May from this Federal Reserve. From New York City this morning, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Lisa Abramowitz and Kenny Lyons, I'm Jonathan Ferro. Futures are 0.4%. The price action once again, Lisa, in the bond market.
Very much so, as you see those yields shoot higher. Shocking to see where we were just last year. And now we're looking up toward perhaps a 2.4% 10-year yield, and looking at a 2.2% if you round up 2-year yield. How much are we bringing forward Fed hikes, and how much is the Fed going to actually respond in tandem?
And Lisa, what do you make of all the bunching up through the yield curve? The slight inversions here and there, 2s, 10s down to 18 basis points.
It's a bet that the Fed can get back to a more normal level of inflation. It's a bet that we're going to get a shallow recession. It's a bet that we're going to get it in a couple of years, not imminently. And how much will that get retraced as we see the Fed take action? Because frankly, it sounded like Fed Chair Jay Powell yesterday was not only, as this was what Citigroup just said, not only willing to go 50 basis points, but likely.
Back to back, perhaps as well. I just read that Citi note too from Andrew Hollenhorst, and that's what Goldman's looking for. Back-to-back 50 basis point hikes. Mohammed Al-Erin coming out swinging on Bloomberg Opinion this morning. Kaylee, the Fed being pushed into a developing economy camp. An EM chairman down in D.C.
Well, I think that's really interesting, because what we're realistically talking about, what Citi and what Goldman Sachs and Jan Hatzius are talking about, is 100 basis points higher on the Fed funds rate over the course of just 2 meetings. And yeah, this is akin to the moves you see in emerging markets like Brazil, which has been moving 100 basis points per meeting. Really drastic action to try and get inflation under control. I guess the question is, John, if we see aggressive action at the beginning, does that ultimately change how high the terminal rate will go? The answer for Goldman is yes, 50 in May, 50 in June, yet you're still looking at 3 to 3.25% at the end of this hiking cycle.
A few points to make here, Lisa, and it's difficult for this Federal Reserve when you have upside risk to inflation and downside risk to growth. And for some people, I stress for some people, a question around the credibility of the policy of the last 12 months.
Well, that's what Mohammed Al-Arian was pointing to, this fear of losing their credibility and trying to respond in a strong way to regain it. I just wonder how that shifts their strategy and how much they clearly don't know how this is going to develop. None of us do, but how they try to maintain that credibility. Is it with having a harder fist going forward, 50 basis point rate hikes, as well as perhaps a more active shrinking of the balance sheet?
Well, what happened to the debate around front-loading the rate hikes? That's what we used to talk about a number of months ago. What happened to that in the meeting last week?
Well, frankly, it seemed like they were shocked by the Ukraine crisis and were trying to wait to get a sense of just how much the risks would be skewed to higher commodity prices versus a slowdown in growth. Those were sort of the dueling and opposite risks. And it seems like they've come out realizing that inflation is really their preeminent concern, so they're going to be more aggressive coming forward. But that's delayed by a couple of months, this front loading that a lot of people were expecting.
Yields climbing again this morning. Good morning to you. 216 on twos. Up 5 basis points on the day. Futures up 1/3 of 1% on the S&P, and the Nasdaq up 1/3 of 1% also. 10-year yields higher by 5 basis points to 233.87. Crude lower by, let's call it 1% to 111. Euro dollar just about holding on to 110. Muted price action there. Anything but on dollar yen. A big move through 120 early this morning. We'll touch on that a little bit later. Lisa, so much still to come.
Yeah, and that really speaks again to that divergence in policy with the Japanese central bank holding rates where they are around in their negative rate policy, even as the Federal Reserve moves. If you want to get more clarity on the Federal Reserve, a slew of Fed speakers will be speaking today. 8:30 a.m., St. Louis Fed President James Bullard will be joining Bloomberg Surveillance. How much does he edify this 8 rate hike expectation, 25 basis point rate hike expectation, I should say, through February of next year? How much does he say they need to get even more aggressive? Because we have heard him take somewhat of a hawkish tone, as well as other Fed speakers throughout the day. New York Fed President John Williams, I'm watching that one, considering that he is concluded in the leadership of the Federal Reserve. San Francisco Fed President Mary Daly, Cleveland Fed President Loretta Mester. How much do they talk about this flattening 2-10s curve, that spread getting below 20 basis points for the first time since early 2019? How much do they talk about the 530s curve, the gap between 30-year and 5-year yields shrinking to the narrowest since 2007? We know what happened in 2008. How much are they looking at a longer-term slowdown, secular stagnation, all of these types of terms? How much are they trying to get away from that as they try to be aggressive now? And today is day one of the Bloomberg Equality Summit. The CEOs of Macy's, Visa, the chair of New York Stock Exchange and New York Life Investment Management, all joining. How do they view the idea of ESG, environmental, social, and governance, in light of a shock? In light of something that actually changes the landscape on both an ethical standpoint as well as on a commodity standpoint? How nimble can some of these categories be, John, as so many people increasingly allocate to these categories?
Lisa, thank you. Happening right now, Germany's foreign minister is speaking at a Tesla factory opening near Berlin. And this headline gets your attention, Kaylee. We want to be independent from Russian crude. Whether they choose to make a major move this week, though, that's a different question.
Yeah, well, and the question, John, is yes, they are seeking independence, energy independence from Russia. How quickly can they get there? Because that is really the pivotal point when the European Union is considering potentially an embargo on Russian fossil fuels. You got to make a transition somehow, and that takes time.
You need everybody to agree on that this week for it to happen. And Lisa, to get everybody to agree on that this week for that to happen, I think it's going to be incredibly difficult, given that Hungary came out yesterday and just said, red line, no thank you.
Very difficult is a diplomatic way of saying not going to happen. They all have different reliances on Russia. And frankly, the legwork that has to go into creating some supplies is vast. And so how quickly can they get that online?
The team coverage starts right now with Bloomberg's Joe Matthew down in Washington, Maria Tadeo in Brussels. Maria, first to you, and this headline that comes from Germany's foreign minister. We want to be independent from Russian oil. What they choose to do this week, though, Maria, that remains to be seen.
Well, it really remains to be seen. And Jonathan, there's two big dates to watch out for. Of course, Thursday, that is a big meeting, the big diplomatic push between the United States and, of course, the European delegations meeting here in Brussels. And then, of course, a Friday morning session in which European leaders will debate around energy. Now, the big question continues to be, are we going to see anything that looks like a full U.S. embargo on Russian energy imports? And I have to tell you, when I speak to my sources here, they say this debate is very much back on the table. A week ago, the Germans try to push it aside and put it to the corner, but it is back at the table, partly because the Eastern Europeans, and I'm of course referring to Poland, the Baltics, Estonia, Lithuania, they want this to be a flashpoint in this debate coming up at the end of the week. But when I also speak to the same sources and I put this question very clearly, then are we going to see it happening by the end of the week? The answer I get is no. At this point, we're not there yet. There is no unanimity. You said it very clearly. In the European Union, you need the 27 member states to agree to a massive resolution like that. And then, of course, you have the Hungarian President, Viktor Orban, who is running for re-election in 2 weeks, who has a very complicated relationship with the European Union, but also with Russia and Vladimir Putin, saying, for me, this is right now a red line. I will veto this.
Joe, in the meantime, we heard from Francisco Blanche of Bank of America that this entire conflict will lead the United States to be dominant in the exports of liquefied natural gas as well as shale. How much are we seeing the groundwork being laid by the administration to help make that happen?
Well, we know that they've been calling around here for more than weeks, looking for alternate sources of energy. And there was an important meeting that happened yesterday that we've confirmed that took place at the White House with the CEOs of 16 companies, including oil and gas companies, the big integrated oil companies like Exxon, ConocoPhillips was there, along with some refiners and even some companies representing the renewable energy space, as the president tried to give them a heads up on the number of needs that are coming. A readout from the White House says they discussed the need to work together to address Vladimir Putin's disruptions to global markets and supply chains, especially, they say, for energy and agricultural commodities. This is clearly an administration that is aware of disruptions that could be on the way.
Joe, I know this is going to be a big story for you a little bit later on your program on Bloomberg Radio. I'm looking forward to that. Sound On, coming up a little bit later on Bloomberg Radio, weekdays, 5 p.m. Eastern Time. Do not miss that. Our special thanks to Maria Tadeo, as always. Thank you. Just finding out, I'm going to catch up with Mohammed a little bit later in a few hours, Lisa.
Oh, good.
The burn in this quote from Mohammed in Bloomberg Opinion. Judging from price movements on Monday, the Federal Reserve risks slipping further into a no-win interaction with markets that is more familiar to developing countries that lack policy credibility.
Mohamed El-Erian has been pretty aggressive in terms of how far the Fed had to go and that they were way behind the curve. A lot of people agreed with him, and I guess that what he's arguing is perhaps it's going to be a challenge for them to get ahead of the curve. A lot of people seem to agree, and yet we haven't necessarily seen that long end get unhinged, this feeling of longer-term yields rising uncontrollably. But I wonder, if they don't go aggressively in the next couple of meetings, are you going to start to see a more aggressive move on the long end with Treasury yields spiking?
Well, let's talk about why people doubt why they'll be so aggressive. Is it because people believe the economy can't take it, or people believe that Chairman Powell just won't be willing to deliver what's needed? Which one is it? Is it both? A bit of both?
I think it's a bit of both. I think that also there is a feeling that at a certain point it will disrupt the markets enough to get their attention, but I don't really see how that could be the case, considering the fact they haven't been disrupted so far. And frankly, the Fed seems to think that inflation is a more pressing concern than easy financial conditions by far.
It's just interesting to me that this is the second news conference that Chairman Powell has conducted. Think back to December, and then the one more recently last week, where he said what needs to be said, and we haven't responded to it. And it's later in either the minutes, back in the December meeting, we needed the minutes to be training on that. And then, Lisa, we needed a chorus of Fed speakers to say the same thing for us to start to listen to what might happen in May.
Perhaps the market's listening. Perhaps stocks don't care. Perhaps it won't matter to stocks that yields are going so high. People were saying something very different just a few months ago, that if yields got 2.5% on the 10-year, that would be a game changer. We're not seeing it right now.
Futures up a third. We're doing okay on the S&P. Yields up again by 5 basis points to 233.69 on a 10-year. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. Russia is refocusing its military campaign in Ukraine on the east in what may become a narrower set of goals for Vladimir Putin on one of the primary targets, the port city of Mariupol. The bombardment of the city has continued as a Russian deadline for surrender expired. The intensity of the attacks is striking given the slowing Russian war effort elsewhere. President Joe Biden is warning the private sector, improve your defenses against cyber attacks immediately. The president says the Kremlin may be plotting cyber attacks to retaliate for sanctions imposed for the invasion of Ukraine. The White House provided few details about the nature of that threat. And Federal Reserve Chair Jerome Powell is now using a more aggressive tone towards curbing inflation than he did just a few days ago. Powell says the Fed is prepared to raise interest rates by a half percentage point at its next meeting if needed. Last week, policymakers increased the benchmark lending rate by a quarter point. Investigators are trying to figure out why a China Eastern Airlines Boeing 737-800 suddenly fell from the sky. The crash in the southwestern part of the country is believed to have killed all 132 people on board. Air crash experts are baffled by the plane's nosedive from 29,000 feet. Meanwhile, China Eastern grounded its fleet of those planes. And Alibaba has ramped up its share buyback to $25 billion. China's e-commerce giant is reacting to staunch a $470 billion loss of value during Beijing's internet crackdown. The government has pledged to support the economy and finish the clampdown on the tech sector as soon as possible. That triggered a historic rally in Chinese stocks. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The first step in building a connectome is to get your hands on some brains and then cut them up. It all sounds very grim, but Harvard turns out to be quite efficient with its brain harvesting. Jeff's lab can do a year's worth of research with a single mouse brain. Small chunks of the brain are fed into the slicer, where a diamond blade carves off a thin sliver of tissue. The tissue floats along some liquid and onto a piece of tape. The brain slices are then put into this very large machine, where they're photographed in the finest of detail. Software helps stitch the pictures back together into a single 3D image, and algorithms are applied to help make sense of what's going on inside of the brain.
Bloomberg has the Fed covered all week. Today, an exclusive interview with St. Louis Fed President Jim Bullard.
There's just risk out there, and markets are going to have to price that risk.
Tomorrow, an exclusive interview with San Francisco Fed President Mary Daly.
Balance sheet policy is just another part of our policy toolkit.
The most in-depth coverage and analysis of the Fed.
Which meeting matters?
Every meeting matters.
Continuing coverage this week on Bloomberg Television and Radio.
The expectation going into this year was that we would basically see inflation peaking in the first quarter, then maybe leveling out, and then see a lot of progress in the second half. That story has already fallen apart to the extent it continues to fall apart. My colleagues and I may well reach the conclusion that we'll need to move more quickly, and if so, we'll do so.
That story has already fallen apart. That was Chairman Powell of the Federal Reserve. A little bit later today, as Lisa's pointed out a few times, more Fed speak, including President Williams of New York. Look out for that. With futures this morning, and good morning to you, up 1/3% on the S&P, on the NASDAQ, up around about 0.2%. Yields higher again by 5 basis points, 233.69. The curve, Lisa, flatter over the year so far.
Yeah, and frankly inverted in several maturities. The question that I have is, when does it start to actually portend recession for markets? It does not seem to be portending recession anytime in the near future if you trust credit markets as well as equities.
President Bullard, 1 hour and 10 minutes away with Mike McKee. We are all looking forward to that. Joining us now is Joanne Feeney, partner and portfolio manager at Advisors Capital Management. I want to start here with you, Joanne, and just go to the price action of yesterday. Yields up, banks down. Can we start there, Joanne? Why?
Yeah, sure. Good morning, Jonathan and team. Clearly the market is adjusting their expectations for bank earnings based on a flatter yield curve. But people have to remember that a lot of the source of loanable funds for banks does come from checking accounts, demand deposits, on which they pay no interest. So any increase in interest rates is going to be a positive for net interest margins. Obviously, it'd be better with a steeper yield curve. And then I think the second thing is the concern over the growing risk of recession, which could impact the amount of loans that they make. So lower loan volumes would also tend to reduce their earnings. But I think overall, banks have a pretty positive outlook here. Given what the Fed is saying, it still looks like we're going to have growing production, growing loans. We're still in a reopening recovery, even if it's a bit slower than we originally expected, given what's going on with commodities because of the Russia war in Ukraine.
Bonds are, meanwhile, Joanne, pricing in a bit of recession risk. Are we seeing the same sort of pricing in equity markets if you look below the surface?
I think what we're seeing in the equity markets reflects the change in interest rate expectations that began last November when the Fed signaled that it was going to start raising rates. We saw these multiples come down really dramatically, and we saw this big reallocation among large institutional money managers, retail investors, et cetera, away from tech and high multiple stocks towards more cyclical stocks, more consumer staples as well. And I think that reallocation, I think we're seeing action in the market that suggests that reallocation